Very happy evening to all. Sir, we are having 1.5 days to prepare our FM and also SM. My first request to you, my dear lovable students, give equal importance to both the paper. What many of the students will do is they will be fully sitting with FM since it is problem paper and they will not properly revise SM. Don't do that mistake. Sir, if you are studying one chapter in FM, immediately you study another chapter in SM. Like that you balance. So my dear lovable students, from this, the order of study in FM financial management is try to prepare the first chapter, leverage analysis. This is the first chapter we are supposed to prepare. After that, try to prepare the ratio analysis, then cost of capital, then capital structure theories, then capital budgeting, and the sixth one is working capital management. Sir, in this, which chapter is more important if you ask me? I will tell you all the chapter are equally important because every chapter will be carrying 5 to 7 mark in exam. That is more or like a paper like FM, which is going to be come for 50 mark in exam, my dear lovable students. If we prepare very quickly every chapter, if we remind every concepts, then my dear lovable students will be able to write the full paper in a better way. With this introduction, we can very quickly revise the first chapter, that is leverage analysis. You know, leverage analysis is talking from sales to the EBIT and EBIT to the EPS. As we all know that sales minus variable cost is contribution. Contribution minus fixed cost is operating profit or EBIT. Basically what we have studied earlier, sales minus cost is equal to profit. What the subject costing is saying that classify the cost into two categories. One is variable cost and fixed cost. So from the sales, that is a total revenue, we have to reduce the variable cost because without incurring the variable cost, we can't, my dear lovable students, generate the sales. So you will be getting contribution. This amount is going to be contributed to recover our fixed cost. So from the contribution, if you reduce the fixed cost, you will get the EBIT or operating profit. Actually, from sales to the EBIT is covered in our subject costing. From EBIT, earnings before interest and tax, you tell me, sir, what you will pay? You will be paying the interest. You will be paying the interest. So from the EBIT minus interest, you will be getting earnings before tax. Sir, my dear lovable students, from the earnings before tax, I have to pay tax at the rate of 30% or 40% or applicable tax rate. I will be getting the PAT, profit after tax. From the profit after tax, if I reduce the preference dividend, I will be getting residual earnings. This residual earnings will be shared by, divided by number of equity shareholders. You will get the EPS, earnings per share. This is called as income statement. You just revise very logically. Sir, as a concern, revenue is very important, right? Our ultimate revenue is what? Sales. In order to make the sales, we have to incur the variable cost, which is nothing but material, labor, and sir, expenses which can be expressed in per unit. All the direct expenses we are accumulator in saying that it is variable cost. So from the sales, if you reduce the variable cost, we will get the contribution. Why it is called as contribution? It is going to be contributed to recover the fixed cost, my dear lovable students. So from the contribution, if you are, sir, recovering the fixed cost, the profit what we are getting is called as operating profit. Operating profit. That is otherwise called as earnings before interest and tax. Basically or technically, if you are seeing the balance sheet, you will be having asset side of the balance sheet and you will be having liability side of the balance sheet. In the asset side of the balance sheet, you will be having fixed assets and you will be having current assets. And in liability side of the balance sheet, you will be having current liability and you will be having the equity and the other liability. Correct, sir? So, my dear lovable students, this current assets and current liability, this full story we are learning in the working capital management. We are learning in the working capital management. This fixed assets, with fixed asset, what we will generally do, we will do the production. What we will do with that produced goods? We will sell the goods. So automatically this fixed asset will create, this fixed asset will generate the sales, my dear lovable students. This fixed assets will generate the sales. In order to generate the fixed asset, generate the sales, we have to incur the variable cost. So we will be getting the contribution. So We are manufacturing the goods with the fixed asset. Surely that fixed asset will be having depreciation. Sir, we will be manufacturing goods in factory, so we have to pay factory rent. All that cost is called as fixed cost. So we will be getting earnings before interest and tax. So basically the asset side of the balance sheet generate earnings before interest and tax. Why I was able to purchase the fixed asset? I was able to purchase the fixed asset because of my sources of fund. What are the various hit sources of fund? Like debt, my dear lovable students. For that I have to pay interest. So from whatever EBIT I have earned, earnings before interest and tax I have earned, I will pay the interest. So what will be balance available with me? Earnings before tax. Actually, the government is like a nominal partner who is there inside my organization. He is like a sleeping partner because I am doing business in India. So I am utilizing the natural resources of India. So whatever profit I have made, 30% should be shared with the government of India. That's why from the earnings before tax, I am paying the tax. So my dear lovable students, I will be getting the profit after tax. From this profit after tax, I will be giving the dividend to the preference shareholders called as preference dividend because they are having some preference over and above the equity shareholders. That's why their name itself is called as preference dividend, my dear lovable students. You will be getting residual earnings. This residual earnings will be shared by the equity shareholders. So divided by number of equity shareholders, you will get the EPS. So leverage analysis is an analysis from sales to the EPS. Fantastic to the core. So from sales to the EBIT, we will be calling as operating leverage. From EBIT to the EPS, we will be calling as financial leverage. And from sales to the EPS, we will be calling as combined leverage, my dear lovable students. So what is a very quick review, sir? Sales to the EBIT, we will call it as operating leverage. From EBIT to EPS, we will be calling as, sir, financial leverage. And minus EBIT and plus EBIT will get cancelled. So automatically sales from EPS, we will be calling as combined leverage. I believe that you are able to appreciate or understand. If you analyze from sales to the EBIT, my dear lovable students, sales minus variable cost, contribution minus fixed cost, earnings before interest and tax. The analysis from sales to EBIT is called as operating leverage. Because since I am operating the business only, I am incurring the fixed cost, right? So the reason for the operating leverage is the fixed cost. What I am analyzing in operating leverage is if 1% sales has changed, how much percentage EBIT will change? This is what my analysis. If 1% sales changes, how much percent my EBIT will be changing? This is what my analysis. Because if the sales increases, variable cost increases. But if the sales increases, fixed cost will not be increases. And if the sales decreases, variable cost decreases. But if the sales decreases also, fixed cost will not decrease. So there is a risk. That risk is called as leverage. That leverage is called as operating leverage, my dear lovable students. So because of whom we are having operating leverage? Because of fixed cost we are having operating leverage. So operating leverage is equal to contribution divided by EBIT. So if you are having any confusions in this formula, because of fixed cost only we are having operating leverage, because that is only fixed. Even if the sales reduces, the fixed cost will not reduce, right? So above the fixed cost divided by below the fixed cost. So operating leverage is equal to contribution divided by EBIT. So from the EBIT, I will be start sharing the earnings to various people. I will be paying interest irrespective of the EBIT. I have to share the same amount of interest. So interest is fixed there. Are you all really with me what I am talking to you? Sir, and sir, preference dividend is also fixed there, my dear lovable students. So even though I have not earned any EBIT, still I have to pay interest. Sir, but since if I don't, sir, earn the profit after tax, no need to pay preference dividend. So financial leverage maybe because of the interest part. Even though I have not earned the EBIT, still I have to pay the interest. So that is a risk element for me. So the financial leverage is equal to EBIT divided by EBIT minus interest, or rather it can be called it as EBIT divided by EBT. You tell me, Because of whom financial leverage is coming? Because of the interest financial leverage is coming. So mele divided by kid, that is above interest we are having EBIT and below interest we are having EBT. This is what the financial leverage. And we can say if we are having preference dividend, if we can have financial leverage with the preference dividend also. Financial leverage with preference dividend is nothing but, my dear lovable students, you can have EBIT divided by EBIT minus interest minus preference dividend divided by 1 minus T, because preference dividend is a post-tax item. In order to convert into pre-tax item, we have to do divided by 1 minus T. I hope that you are able to quickly recall this formula. That's it. Sir, combined leverage means because of two people I will be having combined leverage, because of the operating leverage and because of the financial leverage. Operating leverage is coming because of the fixed cost and financial leverage is coming because of the interest, right? So fixed cost, sir, which is nothing but contribution divided by EBIT. Sir, sales minus variable cost, you will get contribution, minus fixed cost, you are getting EBIT. This is what leverage? Operating leverage. And sir, financial leverage is equal to EBIT divided by EBT. That is operating leverage into financial leverage is equal to contribution divided by EBIT into EBIT divided by EBT. I hope that you are able to appreciate. This EBIT and EBIT will get cancelled. You will be getting contribution divided by EBT is what the operating leverage, the combined leverage. That's it with regard to the leverage analysis. So sales minus variable cost contribution minus fixed cost EBIT minus interest, my dear lovable students, you will get EBT. You have to pay the tax. Balance available is called as PAT. From that, pay the preference dividend. Balance available is called as, sir, the residual earnings that you share with the equity shareholders. Comfortable? These are the three leverages. From sales to the EBIT, we will call it as operating leverage. From the EBIT to EPS, we will call it as financial leverage. From sales to EPS, we will call it as combined leverage. What this study is all about? If 1% change in sales will lead to how much percent change in EBIT? Sir, 1% change in EBIT will lead to how much percent change in EPS? 1% change in sales will lead to how much percent change in, sir, EPS? That's what the study, man. So the study is about, leverage analysis, the consolidation classified into three categories. Number one, operating leverage, financial leverage, and combined leverage. Operating leverage means if 1% change in sales will lead to how much percent change in EBIT. Here 1% change in EBIT will lead to how much percentage change in EPS. Fantastic to the core. EPS. And 1% change in sales will lead to how much percent change in EPS. This is what the study. That is why the formula is, percentage formula is, sir, the operating leverage is equal to percentage change in EBIT divided by percentage change in sales, or percentage change in EPS divided by percentage change in EBIT. And here, sir, percentage change in, sir, EPS divided by percentage change in sales. Very simple, sir. So from this chapter, we have quickly revised all the formulas: operating leverage, contribution divided by EBIT, financial leverage, EBIT divided by EBT, and combined leverage, contribution divided by EBT. And we have also discussed about the, sir, percentage change formula also. I will give you, sir, at 20-30 minutes of time. You can solve any 5 questions from this chapter to get a flow. And you comment me which chapter you want as a quick revision from the financial management. I'm ready to revise all the chapter. Sir, practically, sir, use this 1.5 days available. Don't worry about the past paper. We can ensure an exemption in both FM and SM. That is what our target is all about. Thank you. Bye-bye from ANM. Sir, very, very, very happy evening to all. Sir, in our FM revision, quick revision series, this is the second chapter we are doing. As I already told to you the order of study, the first chapter is leverage analysis. I have uploaded a very quick revision of leverage analysis within 15 to 20 minutes. I hope that you have gone through that video and got benefited from that. And we are moving into the second chapter, that is ratio analysis, another a 5 to 7 mark area for examination. Sir, ratio analysis means basically comparison of two figures in the financial statement. We clearly know that we are having trading account, P&L account, and balance sheet. In that, we will be sometimes taking numerator and denominator both from the trading account, or both from the P&L account, or both from the balance sheet, that too both from the asset side of the balance sheet or both from the liability side of the balance sheet, or we may interlink the P&L account and balance sheet. Sir, the first one, every entity want to know about the liquidity ratio. Liquidity ratio, right, sir? For example, you may be, sir, lot of money you may having, like, sir, Adani or Ambani or whoever it may be. You may have 10,000 crores of FD. But if you're going to a shop to have a tea, you should have, sir, 10 rupees or 12 rupees to pay that, sir, half bhaji or the tea, whatever it may be. So you should have liquidity with you. For that, we are having specified ratio, my dear lovable students. In that, the first ratio is current ratio. What is the first ratio? Current ratio is equal to current asset divided by current liability. You also tell along with me, current ratio is equal to current asset divided by current liability. Basically, what I am checking is how much current assets I am having to meet my current liability. That's it. It's a simply measure that estimate whether the business can pay short-term debt. Ideal ratio is 2:1. If I am having 1 rupee current liability, if I am having 2 rupees current asset, that's it. That, sir, entity is having good liquidity. I am moving into the next ratio called as quick ratio. So in current ratio, we are checking current asset divided by current liability. In this current asset, we will be having inventory. In this current asset, we will be having prepaid expenses. Right, sir? Sir, you tell me inventory and prepaid expenses. Now inventory is only with me. I have to sell the inventory. It has to be converted into debtor, and debtor has to pay me the money. And prepaid expenses means I have already paid the money. Are you really with me? So these are little hard current asset as compared to cash in hand. So what the next ratio is saying, that quick ratio, further you dig it the current assets. That is quick asset divided by current liability. Quick asset divided by current liability. That means from the current asset, remove the hard current asset such as inventory and prepaid expenses. You will be getting soft current asset. Soft current asset. That means which is more liquid. With that, how much, sir, you are having, sir, if you are having 1 rupee current liability, 1 rupee will be the soft current liability, that is called as quick asset. So what we are checking, my dear lovable students, liquidity ratio. Liquidity ratio means in that we are going to check the liquidity of a concern. In that current ratio, current asset divided by current liability. How much current asset I am having to meet the current liability. If it is 2:1, happy. What is quick ratio? Quick asset divided by current liability. What is quick asset? Which is nothing but current asset minus inventory minus prepaid expenses. That is inside the current asset. We are removing the hard current asset. That is coming to the cash ratio. Furthermore soft. That is inside the, sir, quick asset. We are having little more hard. So I will be taking only the cash and bank balances, which is nothing but the, sir, cash in hand, cash plus marketable securities. If I have invested in shares or security, if I click, I will get the money from the share market, right? This is the most liquid one divided by current liability. So in order to meet my current liability, how much current asset I am having is called my current ratio. In order to meet my current liability, how much quick asset I am having is my quick ratio. In order to meet my current liability, the most liquid one, which is cash and marketable securities I am having, is my cash ratio. Sir, basic defense interval. You show like this, man. Basic defense interval. What is basic defense interval? Sir, for example, I will tell you, if you are spending daily 500 rupees per day, your expenses per day expenses is 500. And if you are having 5,000 rupees in your hand, for next year, how many days you will be tension free? 10 days. Because one day you are spending 500, 5,000 rupees is with you. So for next year 10 days, money is available. The same thing. Cash plus bank balance and marketable securities, basically cash in hand, divided by total operating expenses, sir, for number of days. That is operating expenses per day. If the operating expenses are 500 rupees per day, and if I am having 5,000 rupees with me, sir, for the next 10 days, I can survive. That is called as basic defense interval. You quickly tell me what is current ratio? Current asset divided by current liability. Ideal 2:1. Sir, join along with me. Quick ratio, tell me very quick. Quick asset divided by current liability. What is ideal ratio? 1:1. Cash ratio means cash plus sir marketable securities divided by current liabilities. Everything we are checking in order to meet the current liability, how much current asset I'm having, how much quick asset I'm having, how much cash I'm having. Right, fantastic. Basic defense interval means how much cash in and available divided by sir operating expenses per day. Next one is net working capital, which is nothing but total current asset amount minus current liability. That is a net working capital. That is what I have invested in the business as net working capital. I believe that you are very done with the liquidity ratio. Clear? One last time along with me. Are you ready? Current ratio is equal to current asset divided by current liability. Quick ratio is equal to quick asset divided by current liability. Cash ratio is equal to cash plus marketable security divided by current liability. Basic defense interval is equal to cash plus bank balance, that is marketable securities divided by operating expenses per day. Net working capital is equal to current asset minus current liabilities. Fantastic to the core. I'm coming to the capital structure ratios. For example, if you are having balance sheet, surely liability side of the balance sheet shows the sources of fund, right? In that you will be having equity, my dear lovable students. You will be having debt, my dear lovable students. So out of your total capital structure, how much is equity? How much is debt? How much is the debt equity ratio? That's all what we are going to talk about. Equity ratio. The first one is equity ratio. For example, sir, 60 rupees is sir equity and 40 rupees is debt. You have started a company with 60 rupees equity and 40 rupees debt. You tell me total 100 rupees is the capital employed. Out of this capital employed, how much is the equity? Shareholders equity is 60 divided by what is the total capital employed? 100 into 100 means 60% is the equity ratio. That means out of the total capital employed, how much is the equity component? That's why equity divided by capital employed into 100. Wow, super sir. Next one, debt ratio. You tell me, you design. Very simple. Out of my total capital employed, how much is my debt? Which is nothing but 40 divided by 100 into 100%. That's it. That is total outside liability. That is debt divided by debt plus net worth, which is nothing but again capital employed. So if 60 rupees is equity, 40 rupees is debt, total capital employed is 100. So out of 100, 60% is equity and 40% is debt. That's it. That is called as equity ratio and debt ratio. Then what are you talking about debt equity ratio? We talked about current ratio, current asset divided by current liability, the same way debt divided by equity. If I am having this much equity, I am having how much debt? So total outside liability, which is nothing but debt divided by equity, which is nothing but shareholders equity. Comfortable? So can you say the sir formula till now? Equity ratio is equal to shareholders equity divided by capital employed. Debt ratio is equal to total outside liability divided by capital employed. Again, you can say the same. Debt to equity ratio is equal to total outside liability. That is debt divided by equity. That is enough. Next one, debt to total asset ratio. I will tell you a very quick shortcut for this, my dear lovable students. They may say that A to B, which is equal to A by B. That's it. Anything to anything is equal to, for example, X to Y is equal to X by Y. That's it. So debt to total asset ratio is equal to debt divided by total asset. That's it. That's it. Fantastic to the core. Sir, capital gearing ratio. Sir, you would have heard about car, right? That will be one. Sir, very recently the third position, right? In that there will be gear. For what purpose we are having gear? Gear is there to increase the speed. So inside your capital structure, if you are having preference share capital and sir, debentures or other borrowed fund, basically debt fund is there. Whatever may be the amount of EBIT you have earned, you have to pay fixed payment of interest, fixed payment of return to those people. So because of paying less to those people, we will be having more balance for the equity shareholders, right sir? That's what capital gearing ratio, preference share capital, because whatever PAT you are having, you are going to pay the same amount of preference dividend. And sir, debentures, same amount of interest, so they will eat less only. So because of including preference share capital and debt in the capital structure, the speed of earnings of the equity shareholders will increase. So because of preference share capital and debt in the capital structure, the earnings of the equity shareholders are increasing. So they are having a capital gearing ratio. Fantastic, sir. Sir, proprietary ratio. Proprietor means the owner. Out of my total asset, how much is the proprietor fund? For example, if I am having 1000 crore asset And the owner's fund is only, sir, 9 crores or 90 crores, which is very less. If 900 crores is owner's fund, wow, that means 90% of the company is owned by the owner. That's what this ratio is all about. That is proprietary fund divided by total asset. Proprietary fund divided by total asset. Out of my total asset, how much is the proprietary fund? So with this second family also comes to an end. This is called as capital structure ratio. Shall we quickly revise capital structure ratio? You tell me. Equity ratio is equal to shareholders equity divided by capital employed. Debt ratio is equal to, sir, total debt divided by capital employed. Debt equity ratio is equal to debt by equity. Debt to total asset ratio is equal to debt divided by total asset. Capital gearing ratio is equal to debt plus preference shareholder or preference shareholder plus debt divided by, sir, total equity shareholders fund. Proprietary ratio is equal to proprietary fund divided by total asset. Are you able to recall? I hope yes, sir. If yes, share your happiness in the comments, my dear lovable students. Moving to the third family called as coverage ratio. Sir, I'm going to talk about coverage ratio, debt service coverage ratio. For example, for a concern, the main concern will be how I am going to serve the debt. When you are playing shuttle and all, we used to serve, no. What I will serve? The shuttle ball I will serve, right, sir? Like the same way, the concern should be able to serve. What they should serve, man? Earnings before interest and tax. From this EBIT only they will pay the interest, right? You will be getting earnings before tax, sir. From that tax will go, you will get the PAT less preference dividend. You will be getting residual earnings divided by number of equity shares. You will give that the EPS. Are you all really with me? So the entire EBIT is not only for the debt holders, because in this one part is interest, other part is tax, other part is preference dividend, and other part will go to the number of equity shareholders. So I can't take earnings before interest and tax. That's why to that EBIT we have to make certain adjustment to get the earnings available for debt service. Earnings available for debt service. Sir, to the debt holders, what I should pay? I should pay interest and installment. So how much money is available with me? The same way, current asset divided by current liability. In order to meet the current liability, how much current asset I am having? In order to meet the interest and installment, how much earnings available for debt service I am having? That's it. That's what debt service coverage ratio. Enjoying, sir? Next one is interest coverage ratio. Very simple. You look at here, from where you will pay the interest, man. From EBIT only I will pay the interest. Because if I am having sufficient EBIT, from that I will pay the interest. That's why interest coverage ratio is equal to EBIT divided by interest. Mele divided by kira. Because from EBIT only I will pay the interest. That means the same logic. In order to pay the interest, how much EBIT I am having? Because I will pay the interest from the EBIT. Fantastic. Now preference dividend coverage ratio. From where I will pay the preference dividend, sir? Very simple, from the PAT. That means PAT divided by preference dividend. In order to pay this much amount of preference dividend, how much PAT I am having? Wow, super, sir. That's it. The last ratio, fixed charges coverage ratio. Fixed charges means I know that sales minus variable cost is contribution minus fixed cost is EBIT. Inside this fixed cost, depreciation will be there. You tell me, is depreciation is a cash item or a non-cash item? Depreciation is a non-cash item. So because of including depreciation inside the fixed cost, automatically fixed cost would have increased. Because of increase in fixed cost, my dear lovable students, sir, my EBIT would have reduced. So that is not the cash balance available. That is not the cash balance available, my dear lovable students. Yes, sir. So what I have to do is I have to take the EBIT, add depreciation. That means I will get the cash from operating activity. You know, you heard about AS3. EBIT is the operating profit. That operating profit is after depreciation. So I have to take the cash from operating activity divided by interest plus repayment of loan. Loan means the principal portion. That will surely be after tax. So in order to make it to before tax, divided by 1 minus T. This is nothing but cash flow from financing activity. Basically, cash flow from operating activity divided by cash flow from financing activity. That's what fixed charges coverage ratio. Super, sir. The second family also comes to an end. Can we quickly recall? Will you also open your mouth? Join along with me. Debt service coverage ratio is equal to earnings available for debt service divided by interest plus installment. Interest coverage ratio is equal to EBIT divided by interest, and preference dividend coverage ratio is equal to, sir, PAT divided by preference dividend, and the fixed charges coverage ratio is equal to EBIT plus depreciation divided by interest plus installment divided by 1 minus T. Comfortable? If yes, share your happiness, my dear lovable students. If this family is very comfortable, sir, just show like this, just like the video, then I will proceed further, my dear lovable students. I'm moving into the next one, man. Activity ratio, efficiency ratio, performance ratio, turnover ratio, shortly called as TAP ratio. TAP, T stands for, sir, turnover ratio. A stands for activity ratio. P stands for performance ratio. Sir, can we come to that? This is the one of the easiest slot available. Sir, total asset turnover ratio. I will tell you one thing. Sir, turnover ratio is equal to turnover by that particular item. That's it. Always keep the turnover on top. Because we started with the sales minus variable cost contribution like that. No. So, any turnover ratio, turnover divided by particular item. Now, you tell me, total asset turnover ratio. What is the formula? Sir, sales divided by total asset. That's it. That's what sales, or you can take it as cost of goods sold, because inside the sales profit will be there. So if you remove the profit, you will be getting cost of goods sold divided by average total asset. Divided by average total asset. That's it. Fixed asset turnover ratio. You tell me, sales divided by fixed asset. That's what sales or cost of goods sold divided by fixed asset. Capital turnover ratio. You tell me, sales divided by capital. That's what sales or cost of goods sold divided by net asset. What is net asset? Net asset is nothing but, my dear lovable students, capital employed. Correct? Because the liability side of the balance sheet should be equal to the asset side of the balance sheet. That's it. Working capital turnover ratio. Sir, sales divided by working capital. Sales divided by working capital. Sir, in the question, if the sales figures are available, we have to take the sales. Or if the COGS has been available, you have to take the COGS. That's it. Inventory turnover ratio. Very simple. Sales divided by inventory. In inventory, we'll be having opening inventory and closing inventory. Already we have studied in the EOQ root of 2AB divided by C that I will not consider the opening inventory, not the closing inventory. I will be taking the average inventory, 1 by 2 of the inventory. So cost of goods sold or sales divided by average inventory, my dear lovable students. The debtors turnover ratio, what you should take? Sales divided by debtor. Sales divided by debtor. But debtor is mostly connected with only with the credit sales, not the cash sales, because cash sales will not bring you, sir, debtor. That's why don't say sales, change it to credit sales divided by average accounts receivable. What is average accounts receivable? Opening accounts receivable plus closing accounts receivable divided by 2. Getting it? Sir, this can be expressed as debtors velocity also, which is nothing but average accounts receivable divided by average credit sales per day. Average accounts receivable divided by average credit sales per day. For example, sir, simple sir, if my average accounts receivable is 3,60,000 and average credit sales is how much rupees, man? 1,000 rupees. You can simply take your calculator. 3,60,000 divided by 1,000 means 360 days. 360 days is the velocity, my dear lovable students. Sir, if my average credit sales is 10,000, I am making, man. So 3,60,000 divided by 10,000 comes to 36 days. What it is meaning? Very simple. If I am making a credit sales today, my debtor is taking 36 days to pay off me. That's it with regard to the debtor's velocity. Easy. So, sir, payables turnover ratio, which is nothing but sales divided by average accounts payable. But when I make the sales payable will not come. So I have to purchase. That's what average, sir, creditors. Instead of that, sir, credit purchases. Credit purchases divided by average accounts payable. Divided by average accounts payable. One of the finest family, my dear lovable students. So what is the one line summary? Turnover ratio means divided by that particular item. For example, total asset turnover ratio. Simple. Sales divided by total asset. Fixed asset turnover ratio, sales divided by fixed asset. Capital turnover ratio, sales divided by capital. Working capital turnover ratio, sales divided by working capital. Inventory turnover ratio, inventory. Sir, instead of sales, take the COGS. Sir, cost of goods sold divided by, sir, the particular item. Working capital, inventory. Debtors turnover ratio, you have to take the sales divided by average accounts receivable, but don't take sales, my dear lovable students. You have to particularly take the credit sales. For creditors, you have to particularly take the credit purchases. Are you comfortable? Shall I move to the next family, man? The next family is profitability ratio. Profitability ratio will come from the P&L account, right, sir? GP ratio is equal to GP divided by sales into 100. NP ratio is equal to NP divided by sales into 100. Operating profit means EBIT. So operating profit divided by sales into 100. That's it. Profitability ratio also done. Can you quickly join along with me? GP ratio, GP divided by sales into 100. NP ratio, NP divided by sales into 100. Operating profit ratio, operating profit divided by sales into 100. Expense ratio, my dear lovable students. The opposite of profitability ratio is expense ratio. Sir, if 100 rupees is the sale and 70 rupees is the cost of goods sold, 30 rupees is the GP. How you will represent 30 divided by 100 into 100? That means 30% is the gross profit ratio. If 30% is the gross profit ratio, 70% is the cost of goods sold, right? So cost of goods sold is equal to cost of goods sold divided by sales into 100. Simple, sir. Operating expenses ratio. Operating expenses will be there in the P&L account because we know that there are three overheads are there. Production overhead will be there, administration overhead will be there, and selling and distribution overhead will be there. In that production overhead, we already studied in the costing that this is a product cost, whereas these are period costs. So these two will come and sit in the P&L account. So my dear lovable students, administrative expenses plus selling and distribution overhead divided by sales into 100. That is called as operating expenses ratio. Sir, what is operating ratio? In order to operate my business, I have to sell the goods, plus I have to take care of admin, plus I have to incur the selling and distribution. That's what cost of goods sold plus operating expenses. What is operating expenses? Administration and the selling and distribution overhead divided by sales into 100. What is financial expenses ratio? Like we will be paying interest, we will be incurring, sir, bad debt. Sir, such things are financial expenses divided by sales into 100. Comfortable? Very easy. So that is called as expenses ratio. You tell me, cost of goods sold ratio, cost of goods sold divided by sales into 100. Operating expenses ratio, there are two operating expenses are there, admin and selling and distribution divided by sales into 100. Operating ratio, in order to operate the business, I should sell the goods, cost of goods sold, plus operating expenses divided by sales into 100. Financial expenses ratio, financial expenses divided by sales into 100. Getting comfort? Sir, are you able to recall the every formula of the ratio analysis? I hope yes. If yes, sir, I just want to know your happiness by way of comments. Sir, next one, profitability relating to overall return on asset. Very simple, my dear lovable students. Return on investment. This is the next set of formula where return on investment is equal to return divided by investment. That is, look at the name, return on investment. Return divided by investment. What is that? Return divided by investment. It can be either return or it can be profit or it can be earnings divided by investment. That's it. A return on asset, which is nothing but return divided by asset. What is the return? Net profit after taxes. So net profit divided by average total asset into 100. A return on capital employed, sir, which is nothing but return divided by capital employed. What is that return? EBIT is that return. So EBIT, I already told, sir, the asset side of the balance sheet generate EBIT. So EBIT divided by capital employed into 100. These are the various very important formulas for our examination, my dear lovable students. Sir, are you ready to join along with me for the last final wrap up before I wind up the quick ratio revision? Yes, come on. Current ratio is equal to current asset divided by current liability. Quick ratio is equal to quick asset divided by current liability. Cash ratio is equal to cash plus marketable securities divided by current liability. Basic defense interval is equal to cash plus marketable securities divided by operating expenses per day. Net working capital is equal to current asset minus current liability. I hope that every discussion what you have made or we have made is coming to your brain. Fantastic to the core. Equity ratio, what is the meaning? Out of the total capital employed, how much is the equity? Out of the total capital employed, how much is the debt? That's what debt ratio. Debt divided by equity is what debt equity ratio. And debt to total asset ratio. I'm seeing the total asset side of the balance sheet and the liability side only I'm seeing the debt portion. Capital gearing ratio, because of including debt and preference shareholders in the capital structure, equity shareholders are enjoying a lot. Yes, sir. And proprietary ratio, out of the total asset available, how much proprietors fund are there? That's what proprietary fund divided by total asset, getting it. Coverage ratio, sir, someone should cover someone. Are you all ready with me? So debt service coverage ratio, earnings available for debt service divided by interest plus installment. Interest coverage ratio, who will cover interest? EBIT. So EBIT divided by interest, who will cover preference dividend? PAT. So PAT divided by preference dividend and fixed charges coverage ratio, which is nothing but cash flow from operating activity divided by cash flow from financing activity, which is EBIT plus depreciation divided by interest plus repayment of loan, sir, divided by 1 minus T. Then the turnover ratio, TAP ratio, simple, sales divided by the particular item. Total asset turnover ratio, sales divided by total asset. Fixed asset turnover ratio, sales divided by fixed asset. Capital turnover ratio, sales divided by capital. Working capital turnover ratio, sales divided by working capital. Inventory turnover ratio, cost of goods sold divided by average inventory, since we are having opening and closing. Debtors turnover ratio, credit sales divided by average accounts receivable. Sir, creditors turnover ratio, credit purchases divided by average accounts payable. Comfortable? Then, sir, profitability ratio, GP ratio, GP divided by sales into 100. NP ratio, NP divided by sales into 100. Operating profit ratio, EBIT divided by sales into 100, or operating profit divided by sales into 100. Cost of goods sold ratio, cost of goods sold divided by sales into 100. Operating expenses ratio, there are two operating expenses are there. Administrative expenses and selling and distribution expenses divided by sales into 100. Operating ratio, cost of goods sold plus operating expenses divided by sales into 100. Financial expense ratio, financial expenses divided by sales into 100. Return on investment, return divided by investment. What is your return? It may be return or profit or earnings. Sir, what is return on asset? Return divided by asset. What is the return? Net profit after tax divided by average total asset. Sir, return on capital employed, return divided by capital employed. What is that return? If it is pre-tax, EBIT divided by capital employed into 100. We have completed, sir, a very quick revision of the ratio analysis. I believe that this is very helpful for you to quickly revise the chapters. My dear lovable students, don't stop with this. You are supposed to do any 5 question from the ratio analysis, at least 3, to get the flow into the chapter, my dear lovable students. This is the second revision. If you want any further more chapters to get revised, just inform me by way of comments, and also how much you are enjoying these revision videos. This is ANM. Are you all really with me? So I'm wishing you all the very best. Sir, do 3 to 5 questions and quickly come back. We will be revising the another chapter in the pipeline. Thank you. Bye bye from ANM. Sir, very happy morning to all. My dear lovable students, this is the very quick revision video for financial management. In the last revision 2 videos, we have done leverage analysis. And number 2 is ratio analysis. I hope that you would have gone through that videos. And this is the third video, my dear lovable students, which I am going to very quickly talk about cost of capital. Sir, cost of capital is a very important chapter for our examination, which you will be getting 7 to 10 mark in exam. Minimum 7 mark area for exam. What this cost of capital is talking all about. For example, we know that this is the balance sheet. In that balance sheet, we'll be having sources of fund and application of fund. Sir, first a business has to raise the fund called as sources of fund by way of equity share capital, by way of preference share capital, by way of debt, and already they will be having reserves and surplus. For example, someone is investing in your business by way of equity share capital or preference share capital or debt, or already the equity shareholders money, my dear lovable students, they will be expecting something as return. So they will not give the fund for free, my dear lovable students. They will be giving something as return. The investor's expectation is the cost to the company. Investor's expectation is the cost to the company. So cost of capital divided by, sir, cost of capital is equal to cost divided by capital. What is the expectation of the investors divided by, sir, the capital what they have provided is what this chapter. So what this chapter is all about, it is a return expected by the providers of capital. I will be having so many providers of capital, like debt holders will be there, like equity shareholders will be there, like preference shareholders will be there, my dear lovable students. So when they give their money to a business, they will be expecting something in return. So that their expectation is the cost to the company. What are the significance of cost of capital? Why are we learning this chapter? Because evaluation of the investment option. The next chapter is capital budgeting. In that capital budgeting, we will discount the cash flow by using present value factor at the rate of 10%, like that. So that present value factor what we are using is nothing but the cost of capital of the company. Because with the money what they have raised, only they are going to do a project. So my dear lovable students, by doing that project, The project should be able to generate a return or revenue that should be able to satisfy the providers of the capital. Next one, to take the financing decision. For example, in my capital structure, whether I have to include equity or I have to include debt or I have to include preference or I have to do the project with the reserves and surplus or in what combination, if I have to take such a decision, I should know what is the each element of cost. That will be done, sir, by financing decision. And designing of optimum credit policy. Sir, these are the learning objective of this chapter. Once you study this chapter, we will be able to achieve this fine. I'm moving into the first one. You tell me, if you are going to start a business, do you have money with you? Surely no. So what you will be doing? You will be borrow the money. That is called as debt in our subject. Sir, that debt can be classified into two categories. There are two types of debt are there. One is irredeemable debt and other is redeemable debt. Irredeemable debt in the sense means once you borrow the money, you are not supposed to repay for a certain period of time or lifetime. You will not repay at all because the business has been started for an infinite period. We would have already studied in foundation. So my dear lovable students, sir, if the debt is a irredeemable debt, the cost of the debt will be represented as KD. K stands for cost and D stands for debt. Sir, actually K stands for, it should be CD. No, sir. Why it is KD? Because this subject is an international subject, my dear lovable students. You tell me, for the debt holders, for the debenture holders, for the loan providers, what you will pay? You will pay interest. So interest is the expectation of the debt holders. So interest is going to be the cost to the company. But when you are preparing the profit and loss account, which we have already studied in accounts, you will be debiting to interest. Because of debiting the interest in the P&L account, what will happen to the net profit, my dear lovable students? Net profit reduces. If the net profit reduces, automatically the tax will also reduces, correct? So because of debiting the interest in the P&L account, I am having some tax savings. So it is like a cash inflow to the company. If I pay interest to the debenture holders, that is a cash outflow to the company. But because of debiting the interest to the P&L account, I'm having certain tax savings. So it's like a cash inflow to the company. So even though I am paying interest to the debenture holders, I am getting, my dear lovable students, some tax benefit. So cost of capital is equal to cost by capital. I should not take the cost. I should take the net cost. That's why I into 1 minus T divided by what I will get. I will be getting the NP, my dear lovable students. So I into 1 minus T divided by NP into 100. That's what the formula. If the debt is a irredeemable debt, sir, I into 1 minus T divided by NP into 100. I into 1 minus T is the net cost and NP is the net proceeds. So cost divided by capital will show the cost of capital. That's it. If the debt is a redeemable debt, after a certain point of time, I have to repay that debt, right? So surely in future, I have to repay. That is called as redemption value. So in future, what price I'm going to pay is called as redemption value. Today, I will be getting some amount called as net proceeds. So my dear lovable students, year by year, I should really pay I into 1 minus T. This is the return. Every year, the debenture holders will be getting. And the end of the period, debt period, I have to pay the redemption value. You tell me, if the redemption value is 100 rupees and the net proceeds is 80 rupees, my dear, I'm going to pay extra 20 rupees. This is called as premium on redemption. Even premium on redemption is a loss on because of raising the debt holders. So what this chapter or formula is saying that total loss of 20 should be written off, should be amortized, should be depreciated over the period of the debt. So my dear lovable students, 100 minus 80, which is nothing but redemption value minus net proceeds divided by number of life. If it is 5 years, yes, fine, yes, absolutely, sir. Divided by, sir, I have to take the capital. I will be having opening capital and also closing capital. Because since the debt is a redeemable debt, surely year 0 will be there and year 5 will be there. So I can't take the opening capital. I can't take the closing capital. I have to take the average capital. That's why redemption value plus, sir, NP, net proceeds divided by 2. So debt may be a redeemable debt or irredeemable debt. If the debt is a redeemable debt, I into 1 minus T divided by NP into 100. If the debt is a irredeemable debt, I into 1 minus T plus RV minus NP divided by N. Whole divided by RV plus NP divided by 2 into 100 is the formula. Sir, But every time debt, whatever interest you are paying may not be tax deductible. In case if it is not tax deductible, instead of I into 1 minus t, we have to take I plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into, sir, 100. That's what. Sir, it is this formula used where only interest on debt is what deductible? Tax deductible. Sometimes tax are adjusted at the discount or redeemed at a what? Premium. If such discount on issue or premium on redemption are tax deductible, following formula can be used. That means even the premium is also tax deductible. I will be putting 1 minus t here. Instead of I into 1 minus t for the entire thing, I will be putting 1 minus t is what the formula. So this we will not use so much. So we will be using the, sir, cost of debt KD is equal to I into 1 minus t divided by NP into 100. And if the debt is a redeemable debt, I into 1 minus t plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. The another formula where we will be using is called as YTM, which is yield to maturity. You tell me what is yield to maturity? How to calculate the yield to maturity, sir? It's a 3-step approach. Yield to maturity, 3 wordings are there. It's a 3-step approach. Identify the cash flows. First of all, you have to identify the cash flows. Step number 2, calculate NPV, which is nothing but net present value of the cash flows as identified above using 2 discount rates. That means you have to discount it at 10% or you have to discount it at 12%. If you are discounting at 2, you will be getting one positive NPV and you will be getting another negative NPV. Then you have to calculate the IRR, that is internal rate of return. So IRR in the chapter cost of capital is called as yield to maturity. So how to identify the cash flow? This is what step number 1. The relevant cash flows are in year 0, net proceeds in case of new issue or current market price in case of existing debt. For example, if you are issuing today a debt, you will be getting some money today. That's what year 0. And year 1 to N, you will be paying interest. That is I into 1 minus t. That will be a cash outflow. Correct, sir? And N stands for the redemption value at the nth year. So these are the various cash flow associated with the debt, which is nothing but today you will be getting money and every year you will be paying the interest, and at the end of the year you will be redeeming the debt. What is step number 2? You have to calculate the NPV, net present value of cash flows at identifiable by using 2 discount rate. So you have to discount the cash flow at 10% and you have to discount the cash flow at 15%, my dear lovable students. In one discount rate, you will be getting positive NPV, and in another discount rate, you will be getting negative NPV. And you have to calculate the IRR by way of interpolation. That rate is called as YTM, which is yield to maturity. If you want, this is a very quick example for us, my dear lovable students. A company issued 10,000 10% debentures of 100 each on 1/4/2021 to be matured on 1/4/2026. So 21 means 22, 23, 24, 25, 26. So 5 years is the life of the debt. That means the debt are redeemable debt. After certain point of time, we are supposed to redeem it. Company want to know the current cost of its existing debt. If the market price of the debenture is 80, considering 35% tax rate. So step number 1, YTM, you have to first find out the relevant cash flow. So in year 0, current market price is 80 rupees, right, sir? Every year we are supposed to pay interest, which is nothing but always interest will be paid on the face value. So 100 rupees is the face value, my dear lovable students. 100 into 10% is the coupon rate. This 10% is called as coupon rate. So 100 into 10% come to 10. 10 into 1 minus tax rate comes to 6.5 is the net interest what I am supposed to be paid. And on the 5th year, I have to pay the redemption value. They said that the company want to redeem it at par. So they will be paying 100 rupees, my dear lovable students. All the cash flow I have taken. What is the initial cash flow I have taken? What is the, sir, in between the project cash flow I have taken? And also the terminal cash flow I have taken. Now calculating NPV at 2 discount rate. Now I am going to discount this cash flow at 2 rate. For example, 10% and also at 15%. Are you really with me? So in year 0, 80 rupees is the cash flow. Cash flow is 80. Sir, today's rate is today only. So it will be discount at 1 rupees. 80 rupees will go from the pocket of the investor. He will be investing today 80 rupees. So that will be a cash outflow because the chapter cost of capital, cost to the company means the expectation to the shareholder. So YTM will be expressed from the thought process of the investor. So investor is going to pay 80 rupees. Fantastic to the core. So my dear lovable students, for 1 to 5 years, you will be having cash inflow. 6.5 rupees will be the cash inflow. So first year, second year, third year, fourth year and fifth year, you will be having cash inflow. So it's better to take discounting factor, cumulative discounting factor at the rate of 10%. So the present value is 24.64. And on the fifth year, he will be getting 100 rupees as maturity value. The present value factor at 10% for fifth year is 0.621, my dear lovable students. So 62.1. So you will be getting positive NPV of 6.74. YTM is a rate at which the present value of the future cash inflow will be equal to the present value of the cash outflow. That means today 80 rupees is the value. Sir, there is some rate at which my inflows rate will be equal to outflow. That is called as IRR in capital budgeting. That is called as YTM in cost of capital. That means I am having positive NPV. Positive NPV means I am having profit. Profit should not be there, my dear lovable students. So what I am going to do is I am going to increase the discount rate from 10% to 15%. Right, sir? Because since I have discounted at 10%, I got a positive NPV. I don't want positive NPV. I want equal to 0. Or let it be negative also, I will interpolate and I will find out. So my dear lovable students, discounting factor at 15%. Sir, this is the discounting factor. When I discount it, I am getting minus 8.51. Fantastic to the core. So my dear lovable students, now I am calculating the IRR by interpolation. If by way of interpolation, if I am discounting at 10%, I am getting positive 6.74. Super, sir. If I am discounting at 15%, surely if the cost increases, profit decreases. So if the discounting factor increases, profit decreases. That's what happening. I am getting minus 8.41. So if I am interpolating, 12.21 is the IRR of this project. That means that will be the yield to maturity, which is nothing but YTM is a rate at which my present value of the future cash inflow will be equal to the present value of the cash outflow. That's it. Fantastic to the core. So we are having different sources of different types of debt. Debt may be irredeemable debt. Irredeemable debt means I'm not supposed to repay at all. What is the formula? KD is equal to I into 1 minus C plus divided by NP into 100. Sometimes the debt may be redeemable debt. In case if the debt is a redeemable debt, I'm having multiple options to find out the KD. Either I can use the approximation method, my dear lovable students, or I can use the present value method, which is nothing but yield to maturity method. This is a capital budgeting technique I'm using in the cost of capital chapter, right? So KD is equal to I into 1 minus C plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. Fantastic to the core. And using NPV, that is present value method, which is nothing but yield to maturity, which is nothing but the logic is present value of the future cash inflow should be equal to the cash outflow. That means as an investor going to spend 80 rupees today, but is going to get every year net of tax, the interest he will be getting, and on the fifth year he will be getting the residual value, which is nothing but the redemption value. So the present value of the future cash inflow should be equal to 80 rupees. At what rate it will be equal? That rate is called as YTM, because that is the expectation of the equity shareholder or the debt holder. Automatically the expectation of the investor is the cost to the company, is what this chapter is all about. I believe that you are able to appreciate or understand this. Fantastic to the core, sir. Sir, now I'm moving into the next source of finance called as cost of preference shares. Cost of preference shares. So we are done with the first source of finance is called as debt. So with regard to debt, my dear lovable students, a debt may be a redeemable debt or debt may be a irredeemable debt. If the debt is a irredeemable debt, very simple, only one formula will be applicable. If the debt is a irredeemable debt, classified into two categories. If it is a redeemable debt, either you can follow approximation method or you can follow the yield to maturity method. Fantastic to the core. I'm coming to the next source of finance called as KP, which is cost of the preference shares. Are you feeling comfortable and confident? If yes, sir, just put a thumbs up in the video and also share your comments that, sir, this Jan I'm going to pass. That is a self-confidence we are building. Just to create that and to get that one comment only, I'm spending this much of my time with you, my dear lovable students. Sir, preference share capital. For the preference shareholders, what you will pay? You will pay dividend at a specified rate on the face value, right? Sir, for the debt holders, I will be paying interest. The same way for the preference shareholders, I will be paying the preference dividend. Dividend treated as appropriation of after-tax profit. First, I will be calculating the PAT. Are you remembering EBIT? From the EBIT, I will be paying the interest. So, interest is a pre-tax item, whereas the preference dividend is a post-tax item. After payment of tax, only I will be paying the preference dividend and does not reduce the tax liability of the company. But interest will be debiting to P&L account, whereas preference dividend I will not debit to the P&L account, I will be debiting to the P&L appropriation account. Right, sir? It is an appropriation of profit and not the charge against the profit. Whereas interest is a charge against the profit. That's why when we are calculating KD is equal to I into 1 minus T. That 1 minus T concept will not become for the cost of preference shares. Wow, fantastic to the core, sir. So the preference shares also the same way like that. The preference shares classified into two categories, my dear lovable students. Number one, sir, redeemable preference shares and irredeemable preference shares. If the preference shares are irredeemable preference shares, lifelong, I am not going to repay it. Sir, but in Companies Act and all, we said that the maximum life of a preference shares is 20 years like that and all. This is not an Indian subject. This is an international subject, my dear lovable students. In Indian Companies Act, there may be restriction or time limit for 20 years or 10 years, whatever it may be. But internationally, there is no such time limit. Are you all really with me? So, if I am borrowing money by way of preference share capital, the preference shareholders will be expecting preference dividend from me. So that is a cost, that is a return divided by I will be able to enjoy net proceeds into 100. So very simple. Cost of, sir, irredeemable preference shares is PD divided by NP into 100. Super, sir. Fantastic, sir. Whereas if the preference shares are redeemable preference shares, my dear lovable students, if it is redeemable preference shares, what we are supposed to do is very simple. We have to pay PD, preference dividend. This is the return which we are paying to the preference shareholders. And we have to redeem at the time of redemption. There may be loss on redemption or profit on redemption. So plus, sir, RV minus NP, which is nothing but redemption value minus net proceeds. Yes, sir. Divided by N. For example, 100 rupees I have to pay in future, and today I got only 80 rupees. So there is a difference of 20 rupees. That 20 rupees has to be write off over the period of the life of the preference shares. Divided by, since this is redeemable preference share, surely opening liability will be there and closing liability will be there, and I will not take opening liability or I will not take closing liability. I will be taking, sir, average liability. Same like by half of EOQ. So RV plus NP divided by 2 into 100. So RV plus NP divided by 2 into 100. I will be getting the cost of preference shares. Fantastic to the core. Two sources of finance has been done. Number one is debt, redeemable debt, irredeemable debt. And that irredeemable debt will be using only one formula, redeemable debt using two formulas, right, sir? Cost of redeemable preference shares and cost of irredeemable preference shares, PD divided by NP into 100, or PD plus RV minus NP divided by N, whole divided by RV plus NP divided by 2 into 100. I hope that you are comfortable with the, sir, KP also done. I'm moving into the KE. This is the real crux of the discussion of the cost of capital, which is nothing but the cost to the equity shareholders. What is cost of the equity shareholders? You tell me, sir. It is expectation of the what shareholders? Equity shareholders, my dear lovable students. It's very easy to say what is the expectation to the debt holders, because they will openly say that we want 10% interest. And it is very easy to express what is the expectation of the preference shareholders, because they will quickly say that 12% cumulative preference share capital or 12% preference shares. But this equity shareholders is always a headache. They will not express what they want. They will not say what they want. They will not, sir, express what they want. So value of performance dividend by the expectation. Performance means amount paid by the company to the investors, like interest, dividend, redemption price, which is uncertain in case of equity, because equity shareholders are the real owners of the company. Sir, year by year or month by month, like interest, like preference dividend, there is no need that we have to pay this much amount to the equity shareholders. So the expectation of the equity shareholders, we can't find out at all. Right? So that's why, sir, 5 people is having 5 different approach to find out the KE. So one set of people is saying that KE, cost of equity. The first approach is saying that dividend price approach. What approach, man? Dividend price approach. One set of, sir, school of thought is saying that why the equity shareholders are investing in the company is expecting the dividend. So this approach assumes that dividend per share is expected to remain constant forever. So the expectation of the equity shareholders is nothing but dividend. That too, how they are expecting that dividend? Every year I have to get 2 rupees dividend. That's it. Sir, what is the cost of capital? Cost of capital is equal to cost divided by capital. Are you all really with me? Cost is nothing but the expectation of the equity shareholders. What they are expecting? Dividend. That's why KE is equal to DPS1 divided by, sir, in order to enjoy this dividend, in order to get this dividend, they have to invest market price MPS 0 into 100. You tell me when they will get dividend. They will get only next year dividend when we call the AGM. That is why it is not DPS 0, it is DPS 1. In order to enjoy the next year dividend, they have to invest now. That's why it is not MPS 1, it is MPS 0. Fantastic logic, sir. That's why KE is equal to DPS 1 divided by MPS 0 into 100. That's it. Next one, earnings price approach. For example, in a company, if the number of shareholders are very less, for example, there is a company, one person company or private limited company, only few number of shareholders are there. My dear lovable students, will they worry about the dividend or will they worry about the earnings? They will surely worry about the earnings, because if the company earns, it is equal to, sir, that particular shareholder has earned. So they will not worry about the company, the dividend, they will be worried about the earnings. So this approach, sir, correlate the earnings of the company with the market price of each share. So my dear lovable students, so the KE, cost of equity, is equal to EPS 1 divided by MPS 0 into 100. That means the mindset of the equity shareholders is to get the EPS, earnings. It's not about how much they are getting in hand, how much the company is earning. That's why it is EPS 1. It's not EPS 0, EPS 1. So in order to enjoy that EPS 1, my dear lovable students, they have to today invest MPS 0 into 100. That's it. Fantastic to the core. I'm coming to the growth model, man. Growth approach or Gordon approach. Sir, in the dividend price approach, we said that DPS 1 divided by MPS 0 into 100. This DPS 1 means dividend per share, which is 2 per share every year. The equity shareholder will be expecting same return. Sir, how it is possible? Sir, because inflation is there. Every year some growth will be expected by the equity shareholders. So they don't want every year 2 per share. That's what the modern approach is called as growth approach or the Gordon's model, which is nothing but DPS 1 divided by MPS 0 plus G. So the shareholder will be expecting growth. So if 2 rupees, if you pay this year, next year they will be expecting 2.2 or 2.4 or 2.6. Like that, if grow only, the equity share will be happy and they will be, sir, stay with our company. That's what the growth approach or the Gordon model. This has been, sir, put forward by a person called as Gordon. So Gordon said that every equity shareholder will not only expect the dividend in same, they will be expecting growth also. That's why DPS 1 divided by MPS 0 plus G. Fantastic to the core. Sir, sometimes what will happen, you know, when we are raising the equity, we have to list in a stock exchange and we have to pay flotation cost to the stock exchange, my dear lovable students. So if 100 rupees is the market price, 10 rupees or 5 rupees or 2 rupees will be deducted by the stock exchange and company will be able to enjoy only 80 or 90 or 95. That is after flotation cost, I am saying. So the formula has to be changed as DPS 1, which is nothing but the next year dividend, divided by MPS 0 minus flotation cost. That means I can't take the gross market price, I have to take the net market price, because even though the shareholder is paying 100 rupees to the share market, the company is not getting that 100, because from that 100 some 2 or 3 or 4 rupees will go as flotation cost. So the denominator is getting reduced. Company will be able to enjoy only the net capital. That's what cost of capital, cost divided by capital. Sir, I am taking only net cost. That's why I into 1 minus T. So if the numerator is net, denominator should also be net. Click. Fantastic, sir. So I have to take the MPS 0 minus flotation cost plus G. Fantastic to the core, sir. Are you all really with me? Yes, sir. That's it. Next, estimation of growth rate. Okay, you are saying that, my dear lovable students, sir, KE is equal to DPS 1 divided by MPS 0 plus G. You are saying, Gordon is saying that every year the equity shareholder will not have same expectation. Okay, fine. How I will be finding out this growth, G growth rate, how I will be finding out? For that also Gordon itself is giving answer. You can either find out using average method or Gordon's growth model method. This is how you have to estimate the growth rate. What is this, sir? Average method. Average method is nothing but, sir, current dividend, which is nothing but DPS 0 is equal to, sir, DPS 0 into 1 plus G raised to N. This is what they are saying. I will give you, sir, one example. Just see this example. The current dividend, DPS 0 is 16.1. So now the company is paying 16.1. And the dividend 5 years ago was 10. So before 10 years, 5 years, 10 rupees they have paid. So from 10 rupees, it has grown to 16.1. That is growth rate in the dividend can find out as follows. Sir, if there is no growth rate, every year the company would have paid 10, 10, 10, 10, 10. But it has worked out to what? So it has been grown to 16.1 after how many years, man? 5 years. So there is a growth in 5 years, right? So step number 1, divide D0 by Dn. Sir, divided by, which is nothing but 16.1 is the current dividend, right, sir? Dividend, sir, 5 years ago was how much? 10. So 16.1 divided by 10 means 1.61 is the answer you are getting in step number 1. Now you have to go and see the, sir, present value factor, which is nothing but find out the result found in step number 1. What is the result you got? 1.61 in the corresponding year row, that is 5th year. In the present value table, first year, second year, third year, fourth year, 5th year will be there. If you see at what present value factor, you are getting 1.61 in 5 years. See the interest rate for the corresponding column, which is 10%. Therefore, the growth rate will be how much percentage? 10%. This is called as average method, my dear, which is nothing but the grown dividend divided by past dividend. You will be getting the present value factor. You have to go and place that in the table. This is what the first method. Next one, Gordon is saying that, are you feeling this as difficult? Are you thinking that you don't have that table and all with you and you will be a little difficult to find out in examination? Don't worry. I will be giving a G, growth rate, as B into R. B is nothing but earnings retention rate. For example, if 10 rupees has been earned by company, 6 rupees has been given as dividend, only 4 rupees will be there. This is called as B. B stands for balance. Balance available with the company is 4 rupees. So if the company retain that 4 rupees, only that can be invested. Only whatever amount invested, my dear lovable students, can be get it as, sir, growth. If entire amount has been distributed as dividend, how growth will come? Surely growth will not come, right? So out of 10 rupees, if 6 rupees has been given as dividend, only remaining 4 rupees will be there. This 4 rupees is called as balance. This will grow at a rate of R, that is the rate of return on fund investment. That's it with regard to the next approach. So what is the first approach, man? Dividend price approach. DPS 1 divided by MPS 0 into 100. What is the second approach, man? Second approach is very simple, which is nothing but earnings price approach, EPS 1 divided by MPS 0 into 100. And third one is growth approach, which is nothing but DPS 1 divided by MPS 0 plus G. How to find out that G? Don't worry, either you can follow either average method or you can follow, sir, simple Gordon's growth model, which is nothing but B into R. Fantastic to the core. The next set of, sir, method is realized yield approach. Realized yield approach is the next approach, like dividend price approach, earnings price approach, dividend price plus growth approach, earnings price plus growth approach. We are having the realized yield approach, which is nothing but average rate of return realized in past few years, historically regarded as the expected return. As I already told you many times, that cost of capital to the company is the expectation of the equity shareholder with regard to KE. So I will be taking the average realized return. So compute cost of equity based on past records. Based on your past records, I will give you an example what it is. Mr. X has purchased the shares of ABC Limited. Assume you have purchased the shares of ABC Limited for 1000 rupees and received dividend for 5 years at 10%. Always the company will pay dividend at what value? Face value. At the end of the 5th year, he sold the share for 1128. So I will be having capital gain and I will be having also the dividend. The cost of equity as per realized approach will be follows. It will be discount rate which equal the present value of the dividend received in the past 5 years plus the present value of 1128 to the purchase price of 1000. What they are saying, very simple. Sir, you would have invested 1000 rupees, right? You would have invested 1000 rupees. So this will be your cash outflow. And every year you will be getting 100 rupees, 100 rupees, 100 rupees, 100 rupees, because 100 rupees is the dividend. First year, second year, third year, fourth year, and fifth year. 1, 2, 3, 4, and 5. Right, sir? Sir, this will be your cash inflows. And in addition to that, you will be getting 1128 also. Are you really with me? Because this is a redemption value. So if you are discounting at some rate, my dear lovable students, your discounted cash inflow will be equal to discounted cash outflow. Am I right, sir? So my dear lovable students, the dividend 100, 100, 100, 100, 100. And in the 6th year beginning, you will be getting 1128, which is basically 5th year end. 5th year end. So if you are discounting at 12%, your exactly the present value of the cash inflow will be equal to the present value of cash outflow. So I can say that your Cost of capital is 12%. So what are the various methods we have discussed now? Dividend price approach, earnings price approach, dividend price plus growth approach, earnings price plus growth approach, realized yield approach. And the next one is nothing but capital asset pricing model, CAPM, which is deriving a formula that KE is equal to RF plus beta into RM minus RF. Nothing, man. Being an equity shareholder, if you are invested in a bank FD, you would have get RF, risk-free return, right? Plus, if you are investing in the business, if you are getting the same interest rate what you are getting in the bank, then why are you investing in a business? Because you are taking a risk. So you should get some extra return. That's the risk will be represented by way of beta into RM minus RF. Sir, RM is the market return and RF is the risk-free return. So in addition to the risk-free return, I should get some extra premium. This is called as risk premium. Since I am taking risk, I should get some extra return. That is called as risk premium. How much risk premium you should get? That depends upon how much beta or how much risk you are taking. That's why the formula is KE is equal to RF plus beta into RM minus RF. I hope that you are able to appreciate or understand, my dear lovable students. For example, a quick example we can do. The risk-free rate of return RF is 10%. Company's beta is 1.75 and return on the market portfolio equal to 15%. Then cost of capital will be KE is equal to RF plus beta into RM minus RF. So KE is equal to, what is the RF? 10% plus beta 1.75 plus 15 minus 10 come to 5%. So 5% is the extra premium. 5 into 1.75, that is totally, sir, 18.75 is the KE. That's it. These are the various methods. What are the various methods, man? Sir, dividend price approach, earnings price approach, dividend price plus growth approach, earnings price plus growth approach, realized yield approach, and also the next one is capital asset pricing model. These are the 6 various schools of thought for valuing the KE, because determination of KE is the most toughest thing, because they won't get any interest, they won't get any preference dividend, and if the profit is there, we will give equity dividend, otherwise we will leave. So what they are thinking, what their expectation, very tough to find out. I hope that you are able to appreciate or understand. The another major source of finance is the KR, cost of the retained earning. This is whose money? Equity shareholders' money. So in order to understand the expectation of the equity shareholder, we have taken dividend price approach, which is nothing but DPS 1 divided by MPS 0 into 100, or earnings price approach, which is nothing but EPS 1 divided by MPS 0 into 100, or growth model, which is DPS 1 divided by MPS 0 plus G. That means basically KE is equal to KR. Are you all really with me? Because both money belongs to the equity shareholders only. Sir, that's it. Once you find out the individual cost of capital, such as KD, such as KP, such as KE, such as KR, I have to find out the KO. This is called as WACC, weighted average cost of capital. Weighted average cost of capital. Sir, a company makes a mix of various sources of finance. Yes, I will not do the project only with equity, only with debt, only with retained earning, only with preference. I will make a mix of all the 4. So cost of total capital will be equal to the WACC of individual source of finance. Fine. Sir, how to find out the WACC? WACC, WACC. Calculate the total capital from the all source of finance. Example, how much is my long-term capital? How much is my preference share capital? How much is my equity share capital? How much is my retained earning? What are the sources? How much long-term capital? 10 lakh. Preference share capital? 20 lakh. Equity share capital? 1 crore. Retained earning? 5 lakh. Like that, first I have to find out the amount. Next one, calculate the proportion of each source of capital to the total capital. Because sometimes, sir, I may have retained earnings in my capital structure. My total capital employed may be 1 crore. In that 1 crore, only 1 lakh will be KR. Are you all really with me? So I have to find out equity share capital, for example, divided by total capital into 100. So we have to find out the proportion. So how you have to find out the WACC, man? Weighted average cost of capital. This is how we have to find out the weighted average cost of capital. In that, first you have to put the number 1, 2, 3, 4. 4 sources of finance will be there. Then the source, you have to write the source. The first source available will be equity. Then retained earnings will be there. You will be having debt, and you will be having preference. Any order, whatever you want, you can write. And whatever the amount available, my dear lovable students, for example, equity is 50 lakh, retained earnings is 10 lakh, sir, debt is 30 lakh, so 90 lakh, and preference is 10 lakh, total 100 lakh, for example. Then you have to find out the proportion. Okay, fine. What is the proportion? 50% is debt, 10% is retained earning, 30% is debt, and 10% is total 1. Are you all really with me what I am talking to you? Then multiply the proportion as calculated in step 2 with the respective cost of capital, which is nothing but individual cost of capital. Here you have to write the individual cost of capital. Sir, KE, you would have got one answer after you find out as per the dividend price approach or earnings price approach or dividend price plus growth approach or earnings price plus growth approach or realized yield approach or capital asset pricing model. We all know that KR is equal to KE and you will be getting KD and you will be getting KP, my dear lovable students. Then you have to multiply the individual cost of capital with the weight. That's what proportion. That proportion column represents the weight. That's why it is called as weighted average cost of capital. Fantastic. Sir, aggregate the cost of capital. Yes, this is called as the WACC. Sir, what weight I have to take is a big discussion, sir. Either you have to take the book value weight or you have to take the market value weight. Sir, operationally easy and convenient, because in books of accounts, what is the value available? I know. That's what it's very easy. Reserves such as share premium and retained profits are included in the book value of the equity. If you are taking the book value, I will be taking the reserves and surplus. But if you are taking the market value, it is a more correct and present a firm's capital structure. Preferable to use market value weights. If you really want to find out the correct cost of capital, instead of using the book value weight, because it will be historical in nature. But the market value means live. You will know what is the real data, right, sir? Sir, reserves such as share premium and retained profits are ignored as they are in effect incorporated in the value of the equity. So no separate market value for the retained earnings. A very important point, this you should be listen when you are doing these types of sums, because reserves and surplus we will not trade in the market. So already reserves and surplus will be included in the value of the equity share capital. So when you are taking the market value weight, I will not consider the reserves and surplus. If you want one example very quickly, capital structure of a company is as under. For example, 10% debentures, you are having 5 lakh. 5% preference shares, you are having 5 lakh. Equity, you are having 10 lakh. Total 20 lakh. The market price of these securities are debenture 105, preference shares 110, equity 24. After tax cost of capital, KE is 10%, KD is 6.89 and preference shares is 4.08. Sir, you can find out both using WACC, applying the book value and market value, my dear lovable students. If it is book value, very simple, 10% debenture, 5% preference shares, equity, book value 5 lakh and 10 lakh, which is nothing but number of debentures into face value per debenture. You will be getting 20 lakh. You can find out the weight, which is nothing but how much proportion. After tax cost of capital already given in the question. If you multiply with this weight, you will be getting the WACC of 7.7%. Fantastic to the core. So, whereas, but using the market value weight, first of all, debentures, I will be multiplying with the market value of the debenture. 5,000 debenture I am having here, I will be multiplying with 5,000 into 100. But here I will be multiplying with 5,000 with 105, comes to 5,25,000. That is a current capital I can enjoy. So, I am having a net capital of 5,25,000. Whereas with regard to preference share capital, 5,000 into 110, so 5,50,000 rupees, my dear, and 1 lakh shares into 24 comes to 24 lakhs. So 34,75,000 is the value of the firm as per the market. Whereas as per book value 20 lakh, because this is historical cost, surely the company would have grown as on today. That's why 20 lakhs company has been grown to 34,75,000, and this is the weight or proportion. Sir, KE has been, KD has been, KP has been given in the question. So my sir 8.59 will be the WACC. Always, since the market value is more, automatically, my dear lovable students, the KO should also be more. That's why 8.9%. This is one of the beautiful chapter available for our revision. You know one thing, my dear lovable students, we have done with the cost of capital, which is nothing but calculation of KD, calculation of KP, calculation of KE, calculation of KR, and put together calculation of KO, which is nothing but the WACC, which is weighted average cost of capital. I believe that this revision really making value addition for your time. If yes, please put a comment how much you are enjoying and how much this is creating value addition, because that motivate me to do one more chapter or session for you, my dear lovable students. What you are supposed to do is, after this revision, quickly take any 5 questions from this chapter, solve it, and come back to me. I will be ready with any other chapter. Sir, share your happiness for that only. This much we are doing from this side. We'll meet at the appropriate time. Wishing you all the very best for the coming examination. Thank you. Bye-bye from ANM. Sir, very happy afternoon to all. I believe that your preparations for the coming examination is going very well. My dear lovable students, we have revised these topics, my dear. The first one is leverage analysis we have done. Number 2 is ratio analysis we have done. First, we have completed 2 analysis, right, sir? Number 3, we have done the cost of capital. Immediately after the cost of capital, the next chapter to be revised is the capital structure theories. What this chapter is all about, one of the expected area for examination. This chapter is saying that If two companies are alike in all aspect, like there are two companies are there, you can take like A limited and N limited. If two companies are alike in all aspect except capital structure, that means this company A limited, inside the capital structure, equity share capital is there, preference share capital is there, and debt is there. So this is the capital structure of the company A limited. That means I can call this company as levered firm. Whereas this N limited, my dear lovable students, in their capital structure, there is no debt. Only equity share capital, equity is there, and you can take preference is there. That means this company is an unlevered firm. Unlevered firm. You know one thing? Sir, this both company A and company N were doing same business. We can take it as cloth business. Both are doing cloth business. Sir, both have capital employed of 50 lakh. But the only thing is, the company A has split the 50 lakh like 30 lakh rupees equity and preference and 20 lakh in debt. Total, this is how 50 lakhs they came. But for company N, equity is, for example, sir, 50 lakh I'm taking, and preference, both equity and preference comes to 50 lakh. So they are unlevered firm. So if two companies are alike in all aspects except capital structure, will the value of the firm change or not is a discussion. This is what the ultimate discussion of this chapter. When two companies are there and that two companies are alike in all aspects except capital structure. All aspects are one and the same except what structure? Capital structure. Will the value of the firm change or not? Sir, there are certain propositions are there. Yes, if the capital structure changes, the value of the firm changes. This is what theory of relevance. No, sir. If the capital structure changes, value of the firm will not change because both the company are engaged in the same business. Both the company are doing same business. So the business risk of both the company is same. Capital employed is both the companies same. Return, that is earnings before interest and tax of both the companies one and the same. Then how the value of the firm will change is what the discussion is all about. So my dear lovable students, this is what theory of irrelevance. So one segment of people are saying that yes, sir, the value of the firm will change. Another segment of people are saying that no, the value of the firm will not change. So the capital structure theories. Many students will be having a misunderstanding that this chapter capital structure theories is talking about how much proportion of the equity, how much proportion of the preference, how much proportion of the debt. No, that is not at all related to this chapter. In this chapter, we are mainly talking about, my dear lovable students, sir, if two firms are alike in all aspects except capital structure, will the value of the firm change or not? Yes, the value of the firm change. That's what theory of relevance. No, sir, the value of firm will not change. That's what theory of irrelevance. Sir, there are two approaches are talking about theory of relevance. Number one is net income approach and traditional approach, which is shortly called as NI approach and traditional approach. Right, sir? Whereas theory of relevance is talking about net operating income approach and Modigliani and Miller approach. Right, sir? So, these are the quick recap. What this NI approach, net income approach is saying. Net income approach is saying that in your capital structure, try to inject more and more and more debt into the capital structure. The logic what they are saying is you are having KD and KE, they are not at all bothered about KP. They are assuming that there is no such source of preference. They are only having two sources of finance. One is called as debt and equity. As we all know that KD is equal to I into 1 minus T. So KD will always be cheaper source of finance, my dear lovable students, whereas KE is costly source of finance. So in your capital structure, if you are injecting more equity, that is KE in the capital structure, because of its costlier nature, automatically KO increases. Are you all really with me? If KO increases, the WACC, that is if the WACC increases, the value of the firm decreases, because if the cost increases, the profit decreases. If the profit decreases, value of the firm decreases. Are you all really with me? So what this theory technically advocates us to is try to inject more and more and more debt into the capital structure. If you are injecting more and more and more debt into the capital structure, your KO reduces. If the KO reduces, value of the firm increases. That's it. So according to this theory means NI approach. Capital structure decision is relevant to the value of the firm. This is the theory of relevance. What this theory of relevance is saying that yes, if two companies are alike in all aspects except capital structure, the value of the firm will change. An increase in financial leverage will lead to decline in the WACC. Super, one line. If the financial leverage increases, what do you mean by financial leverage? Because of including debt in your capital structure, sir, the equity shareholders will be having some benefit that is called as financial leverage. So if you are injecting more and more and more debt into the capital structure, automatically KO reduces. Why? Logic is because it is one of the cheapest source of finance, while the value of the firm as well as the market price of ordinary shares will increase. So when KO reduces, value of the firm increases. When the KO increases, value of the firm decreases. So conversely, a decrease in the leverage will cause an increase in the overall cost of capital and consequent decline in the value as well as market value of the equity shares. So one line summary of the entire discussion of this theory is try to inject more and more and more debt into the capital structure. If you are injecting more debt into the capital structure, automatically KO reduces. If the KO reduces, value of the firm increases. So the value of the firm on the basis of net income approach can be ascertained as follows. Value of the firm is nothing but value of equity plus value of debt, because as we all know that the balance sheet liability side total is equal to asset side total, right sir? So value of equity plus value of debt, my dear lovable students. So if you are taking into account the liability side total, you will get the asset side total. It's better to do like that. Otherwise, you have to add all the assets and you have to reduce the current liabilities. That is very longest route to find out the value of the firm. It's better to take what is the value of equity and value of the debt. So value of market value of equity plus market value of debt is equal to market value of the firm. And KO is what you are supposed to find out. KO is equal to EBIT divided by value of the firm. EBIT divided by value of the firm. KO can be calculated. KO, it can be taken as a return on investment. Sir, it is a cost of capital to the company. Just now we have completed that. Cost of capital to the company is nothing but, my dear lovable students, expectation to the shareholders, right? So it is a return to the shareholders, which is nothing but return on investment is equal to return divided by investment. What the shareholders and the debenture holders will be expecting from the company, EBIT will be expecting. So EBIT is the return divided by investment for enjoying, to both enjoy debt and equity. That is entire EBIT, they have to invest in the value of the firm. That's why it is value of the firm. That's why EBIT divided by value of the firm. I hope that you are able to appreciate or understand what I am talking to you. Then the next one is traditional approach. Traditional approach is also in the same family of theory of relevance. Traditional approach is also saying that, my dear lovable students, sir, if two firms are alike in all aspects except capital structure, yes, the value of the firm changes. Before I explain what is traditional approach, we will first complete net operating income approach, then come to the traditional approach. What this net operating income approach is saying that, I can explain you like this with this chart. I'm using the ICAI. Sir, we are having NI approach, net income approach. Look at the NI approach. Just now we have completed. In that NI approach, KE is constant, KD is constant, and KO is what? Variable. KE is constant means you inject whatever may be the debt into the capital structure. Try to inject more and more and more debt into the capital structure. Sir, if the debt increases also, the KD will be same. For example, 10% debt, then also 10% may be the KD. You are increasing the debt to 20%, then also 10% may be the KD. You are increasing the debt by 30%, then also KD will be same. 40% debt, then also KD will be same. So what they are trying to say is, whatever may be the debt proportion inside the capital structure, my dear lovable students, KD remain the same and even KE will be same. So because of injecting more and more and more cheaper source of finance, automatically KO will comes down. Automatically KO will come down. If the KO comes down, automatically value of the firm increases. This is what NI approach is all about. Sir, with regard to the NI approach, what NOI approach is saying that how this is practically possible, because this is a big blunder. The reason is, if you are injecting more and more debt into the capital structure, surely, sir, the fear of the equity shareholder increases. Because if you are having less debt, okay, fine, the expectation of the equity shareholders will be minimal. But if you are injecting more and more debt into the capital structure, automatically the firm will be more levered. Whenever the firm is getting more and more levered, automatically the expectation of the equity shareholders will be much high, because they are taking more risk. Because their beta into RM minus RF, that's their beta will be, sir, more. So since they are taking more and more risk, the expectation of the equity shareholders will be more. So automatically KE will increases. So what NOI is saying that, sir, what you are saying is correct. If you are injecting more debt into the capital structure, KD pulls down KO, it's right. KD pulls down KO, it's right. But KE pulls up KO and KO will be intact. Who will be intact? KO will be intact. If KO is intact, then such a theory is called a theory of irrelevance, because if the KO does not change, as my dear lovable students, automatically the value of the firm will not change. Now, just will be quickly go through, only go through is possible now at this short span of time. Otherwise, I will be taking more time and you can't revise that. That's why illustration number 1, we will quickly go through from the NI approach. Rupa Limited EBAT is 5 lakhs. One of the company's EBAT earnings is 5 lakh. Company has 10%, 20 lakhs debentures. So basically 20 lakh into 10% comes to 2 lakh rupees. The equity capitalization rate KE is 16%, right? You are required to calculate the market value of the equity and the market value of the firm. And you have to calculate the overall cost of capital. You tell me. We just discussed 2 approach. Number 1 is NI approach and number 2 is NOI approach. In NI approach, KD and KE will be constant and KD, KO will be variable. So they are asking calculate overall cost of capital. Overall cost of capital means what? KO. That means they are indirectly asking the NI approach. This is how we have to understand in the exam. So if they are asking overall cost of capital, it's an NI approach. If they are asking the cost of equity, it is NOI approach. Because in NOI approach, KO will be constant and equity KE will be fluctuating. I hope that you are able to appreciate or understand what I am talking to you. If yes, just share your happiness, my dear lovable students. So I will be doing statement showing market value of equity and market value of the firm. Market value of equity is nothing but what will be available to the equity shareholders. The company will be earning EBAT. From that EBAT, company will be paying interest. So earnings before tax will be there. And as per all the theoretical approach, we don't have tax and we don't have preference dividend. So this earnings before tax will be the residuary earnings which will be available to the equity shareholders. I hope that you are able to appreciate. So my dear lovable students, if the company earns 5 lakh rupees, from that 20 lakhs into 10%, 2 lakhs will be shared from the EBAT to the debt holders. So the balance available to the equity shareholders will be how much lakh? 3 lakh. So 3 lakh is the amount which will be shared to the equity shareholders. And equity shareholders is having an expectation of 16%. So 3 lakhs divided by 16% means market value of equity is 8 lakh, 18 lakh, 75,000. Right, sir? And market value of debt is nothing but I by KD. They themselves given that the value of the debt is 20 lakh because I means 10%. So 2 lakh is the I divided by KD is 10%. So 2 lakh by 10% come to 20 lakhs is the market value of the debt. So the total market value of the firm is equal to 38,75,000, which is nothing but market value of equity plus market value of debt. You will be getting 38,75,000. Are you all really with me? So I just want the overall cost of capital. Overall cost of capital is nothing but the KO, because in the NI approach, KO will be variable. In that NI approach, what they are asking is what is the cost of capital, which is nothing but the shareholders' return, which is nothing but return divided by investment. What is the total return to the total investor EBAT? So I know that EBAT is 5 lakh. In order to enjoy this EBAT, because EBAT will be shared by both debt holders and also the equity shareholders, they should invest in both debt and equity. That means they should invest in the entire value of the firm. So divided by investment is 38,75,000, 12.9% is the KO is what the discussion. I believe that you are able to enjoy. If anyone, those who are in live, if anyone is enjoying, just share your happiness. I'm understanding, sir. But the next theory is the NOI approach. After immediately NI approach, we are supposed to revise the NOI approach. NOI is actually saying that how the KO will be, sir, variable. Because when you are injecting more and more debt into the capital structure, the behavior of the equity shareholders will not be one and the same. They will start reacting, my dear lovable students. What they will be doing, sir, they will be start reacting, and when the proportion of the debt increases, automatically, look at here, man, automatically their fear also increasing and the expectation of the KE is increasing, right? So in NOI approach, sir, there is net operating income approach. The fear of the equity shareholder increases. And what NI is said is correct. If you are injecting more debt into the capital structure, automatically, sir, the KO is reduced by KD. But my dear lovable students, KE pulls up the KO and KO remain intact. Are you all really with me? Because of no change in the KO, value of the firm will not change. That's what this theory is all about. We will be quickly going through illustration number 4. Amita Limited operating income is 5 lakh EBAT. Firm's cost of debt KD is 10%. And currently the firm employs 15 lakhs of debt. That means 15 lakhs into 10 percentage comes to 1,50,000 rupees is the interest. The overall cost of capital of the firm is 15 percentage. That is a KO. KO is equal to 15 percentage. Whether you inject debt, whether you don't inject debt, sir, anyway the KO is not going to change. Only the equity shareholders expectation will change. You are required to calculate the total value of the firm, and cost of equity is the question. They have asked KE. Sir, KE is asked only in the NOI approach. Are you all really with me? So statement showing the total value of the firm. My dear lovable students, what is the EBIT? This company has earned 5 lakh rupees EBIT. From that 5 lakh rupees, first the company has to pay the interest, because EBIT minus interest. What is the interest? 15 lakhs into 10 percentage come to 1,50,000 rupees is the interest. So the earnings available for the equity shareholder is 3,50,000. Fine. So 3,50,000 is the, sir, balance which can be shared with the equity shareholders. What do you mean by value of the firm? KO, sir, is equal to, as we all know that KO is equal to EBIT divided by value of the firm. This is what we have done in the last question. So I don't want the KO, because in the NOI approach, anyway, KO will be constant. So I want the value of the firm. So value of the firm is equal to, sir, EBIT divided by KO. Are you all really with me? So here, what is the return you are going to give, man? 5 lakh rupees return you are going to give, and the total expectation of the investor is 15%. So in order to earn 5 lakh with an expected return of 15%, you should invest how much today? 33 lakh 33,000, sorry, 333 is the amount to be invested. So if you are investing the capital of 33 lakh 33,333, and if you are having an expectation of 15%, you can earn 5 lakh rupees. This is what the value of the firm. So basically, sir, in the NI approach, I am calculating the KO, my dear lovable students, and in the NOI approach, I am calculating the KE. This is what the basic discussion. Fine. Now I am going to calculation of cost of equity. How I will be calculating the cost of equity? It is very easy. What is the market value of the debt, which is already given in the question? So market value of debt is 15 lakhs of debt, which can also be find out by I by KD, right, sir? I means interest divided by KD. What is the interest, sir? 1,50,000 rupees is the interest, divided by KD is 10%. So 1,50,000 divided by 10% come to 15 lakhs is the market value of the debt. Fine. Then market value of equity. I know the total value of the firm. Total value of the firm is 33 lakh 33,333. What this total value of the firm comprises of? Always the total value of the firm comprises of the debt and equity, right, sir? And inside that, anyway, debt is going to be a fixed component and equity is only going to be a variable component. And out of 33 lakh 33,333, if 15 lakhs is debt, my dear lovable students, 33 lakh 33,333 minus 15 lakh, I should get the value of the equity, right, sir? So 18 lakh 33,333 is the value of equity. That means, so what I am trying to say is, you are having two approach. One is NI approach, another is NOI approach. If it is NI approach, what I will be doing to find out the value of the firm is, sir, value of the debt plus value of the equity will give you the value of the firm, because debt and the equity I have to calculate separately and I have to add it up to get the total value of the firm. Whereas in case of net operating income approach, my dear lovable students, the total value of the firm anyway not going to change, because it's a theory of irrelevance. So KO will not change. If KO will not change, value of the firm will not change. From that, I will be reducing the fixed part, which is nothing but the value of the debt. Then I will be getting the value of the equity. This equity will be finding out as a balancing figure in the NOI approach. Fine. So what is the earnings available to the equity shareholder, my dear? Sir, they can earn 3,50,000. Why? Because the company will be generating an EBIT of 5 lakh rupees. Out of that, 1,50,000 will be given to the debt holders, and balance 3,50,000 will be available to the equity shareholders. So this is the return they will be getting. In order to enjoy this 3,50,000, they have to invest 18,33,333 into 100, means 19.09% is the KE, my dear lovable students, right? So automatically KE increases, and the KE, so the total cost of capital is remain same at 15%. I believe that you are able to appreciate or understand illustration number 4. And you can try illustration number 5, because the same concepts are there. So we have done two questions, my dear lovable students. One is NI approach and NOI approach. The one-line summary of the entire discussion of the NI approach is, sir, if two firms are alike in all aspects except capital structure, will the value of the firm change or not? Is a question. Yes, the value of the firm will change as per the NI approach, because when you are injecting more and more debt into the capital structure, because of the cheaper source of finance, KD pulls down KO, and when the KO changes, automatically the value of the firm changes. But NOI is asking a basic question that how Because when you are injecting more and more debt into the capital structure, the behavior of the equity shareholders or the fear of the equity shareholder increases. Automatically, they will shoot up. What you said is right. When you are injecting debt into the capital structure, automatically the KO reduces. But KV pulls up KO and KO will be intact. If the KO does not change, the value of the firm does not change, then my dear lovable students, then that theory will be a theory of irrelevance. I believe that you are able to appreciate or understand both NI and NOI approach. This is what the NOI approach rule. Any change in the leverage will not lead to any change in the total value of the firm and market price of the shares, as the overall capital is independent of the degree of leverage. This is what this theory is saying, that whatever may be the degree of leverage, whether inside the capital structure debt is there, debt is not there, whatever it may be, the value of the firm is not going to change. As a result, the division between debt and equity is irrelevant. The composition of debt and equity inside the capital structure is irrelevant. Fine. As per this approach, an increase in the use of debt, which is apparently cheaper, is offset by an increase in the equity capitalization rate. So they are introducing a concept called as offset concept. That means if you are injecting debt into the capital structure, surely KO comes down. But because of fear increase to the equity shareholders, sir, KO remain constant. So this is because of the KD and this is because of the KE. So KO remain constant. If the KO is constant, value of the firm will not change. This happens because equity investors seek higher compensation as they are opposed to greater risk due to existence of fixed return securities in the capital structure. That means when you are injecting more debt into the capital structure, automatically the fear of the equity shareholders increases and they will be expecting more return from the company. Automatically the KE increases. So the value of the firm is equal to net operating income, EBIT divided by KO, is what the value of the firm. So one line summary of the entire discussion is, if you are calculating KO, then it is NI approach. And if you are calculating KE, then it is NOI approach. We have done with the two approaches, my dear lovable students. Now the traditional approach is asking another question to the NOI approach and also to the NI approach. What are you talking, man? Because what NI said that, sir, whatever may be the debt proportion, KD will be constant and KE will be constant and KO will be variable. This is what NI approach in one line is all about, right? And whatever may be the debt proportion, NOI is saying that KD will be constant. KD will be what? Constant, right, sir? Okay, fine. But NOI said that KE will not be constant, this will be variable, and because of that, this will be constant, right? This is what the two proposition what we have studied. Now, traditional approach is asking question. For example, if you are borrowing money from a bank, they may give the loan at 10%, right? When you again go and ask the bank, they may give again same at 10%. But if the debt or the loan increases, even the bank will be feeling some sort of what? Risk to give the loan. So automatically, if the risk increases, automatically return increases. So they will be giving loan only at 12% or 15%. But both the NI and NOI is of the assumption that, sir, KD will be constant and KD will be constant. This is a blunder into theories. So what tradition is saying that what you both have said is wrong. Both the KD, both the KE, sir, will change according to the capital mix what you are having. So automatically, my dear lovable students, if the KE and KD, sir, individually changes, automatically KO will changes, right, sir? Because, sir, KE is changing and KD is changing, so automatically KO should change. That's what the traditional approach opinion. So traditional approach is saying that KO will change. If the KO changes, my dear lovable students, automatically the value of the firm changes. That's what from that we'll be doing illustration number 2. A very quick go through, sir. Indra Limited has EBIT of 1 lakh. Already one company is having EBIT of 1 lakh. Company makes use of both the debt and equity capital. The firm has 10% debenture of 5 lakh, which is nothing but, my dear lovable students, 5 lakh into 10% come to 50,000 rupees is the interest they are paying. And firm's equity capitalization rate is 15%. Equity capitalization means KE is equal to 15%. Okay, sir. You are required to compute total value of the firm and overall cost of capital. Overall cost of capital means what? KO. KO has to be calculated in two methods. Number one, either NI approach, under either NI approach, my dear lovable students, or traditional approach, because these two are the theory of relevance. Only if the theory of relevance will be calculating the KO. So you tell me what is the total value of the firm? We will quickly calculate, sir. What is the EBIT given in the question? 1 lakh. What is the interest, which is nothing but 5 lakh into 10% come to 50,000. So the balance available to the equity shareholders will be 50,000. You tell me what is the KE, equity capitalization rate? Is this an, sir, extension or family of the NI approach? In that NI approach, you have to calculate the value of the debt separately and value of the equity share separately, right, sir? So the earnings available to the equity shareholder is 50,000. Yes, sir. That is what the equity shareholder can enjoy because the company will earn 1 lakh. Out of that, 50,000 will be given to the debt holders. Balance available with the company to distribute to the equity shareholder is how much, man? 50,000, right? So this 50,000 and the cap expectation of the equity shareholders are 15%. So if they're expecting 15% and if they want to get an amount of 50,000, they have to invest now 3,33,333, right? What is the value of the debt which is already given that 5 lakh? So the value of the firm is equal to value of equity plus value of debt as per NA approach and also as per traditional approach. So comes to 8,33,333. Are you getting it what I am talking to you? If yes, my dear lovable students, inform me by way of liking the video or share your comments. For just that one comment only taking this much of effort. Fantastic to the core. Sir, overall cost of capital, which is nothing but the KO. As we all know that KO is equal to cost of capital. Cost of capital means return to the investor. So return divided by capital employed. What is the return they will enjoy? EBIT will be the return they will be enjoy. Divided by capital of the capital employed means value of the firm. Easy. So what is the EBIT? Sir, they will be enjoying an EBIT of earnings before interest and tax of how much? Like 1 lakh. And capital employed is so 1 lakh divided by 8,33,333 into 100 comes to 12% is the KO, my dear lovable students. Are you all really comfortable? Yes, sir. Now, with regard to traditional approach, we are having illustration number 3. Just I will quickly go through or revise what this illustration we are supposed to do. Determine the optimal capital structure of company from the following information. Very simple, man. They are having various options, 7 options. Cost of the debt, KD has been given. Look at here, KD, KD, KD. That means whenever you are increasing the debt component in the capital structure, automatically even to the risk of the debt holders increases. When the debt holders increases, even the expectation of them also increases. So KD should also be increased, right, sir? And cost of equity, which is nothing but KE, man. Sir, whenever you are injecting the debt component in the capital structure, automatically the fear of the equity shareholder increases. That's why from 13, it has become 14, it has become 15, it has become 16, 18, and 20. And like that, it goes, my dear lovable students. So what we are supposed to do in every, sir, capital mix, we have to work out the KO. Because sir, when the debt changes, KD changes, KD changes, KE changes, KE changes, KO changes. When the KO changes, automatically the value of the firm will change is what our discussion is all about. Right, sir? So here the percentage of debt on total value is 0,0. That means it is an all equity company. All equity company means inside the capital structure debt is not there. So my dear lovable students, which is nothing but only KE is there. So 13% will be the value of the firm. That's it, 13%. The next one, 10% debt is there. So we have to find out the proportion. So 11% into 10%, whereas the remaining 90% constitute what? Equity. So this is what they have taken, 11 into 10%. This proportion shows the debt and 13 into 9%. That is total 12.8% is the KO. So like that in every case, just can you say 3? Can you say the third case? Sir, 20% is the debt. Up 11.6 into how much percentage? 20% and sir, 14 into 80%. Totally 100%. That's it, my dear lovable students. You will be getting 13.52, sir. At what KO, the value of the firm will be very high. Where the KO reduces, value of the firm will be very high. Sir, what is the cheapest source of KO? In all that, 12.8 is the cheapest source of KO. So it's better to have 12.8, my dear lovable students. That's what they will be mentioning. Second option is the best because it is having the lowest KO. Because when the KO reduces, value of the firm increases. This is what they are talking about. I believe that you are able to appreciate or understand what I'm talking with you. That's it with regard to the next approach. Also, traditional approach. We have done 3 theories. Number 1, NI approach. What NI is saying that try to inject more and more and more debt into the capital structure because as compared to the debt and equity, KD is the cheapest source of finance. If you are injecting more and more and more debt into the capital structure, KD pulls down KO. If the KO reduces, value of the firm increases. Beautiful theory. But NOI is saying that how far? Because when you are injecting more and more and more debt into the capital structure, the fear of the equity shareholders increases and automatically the KE increases. So what you said is exactly right. If this is the KO, my dear lovable students, when you are injecting KD, KO reduces. But the fear of the equity shareholder increases and the KE pulls up the KO and that's it, game over. KO remain intact. So it's not a theory of relevance, it's a theory of irrelevance. So if two companies are alike in all aspects except capital structure, only just because of difference in capital structure, the value will not change is what the net operating income. Now the traditional approach is asking that both of you are wrong because both of you are saying that KD will be constant. How KD will be constant? If you start borrow over a particular period of time or over a particular limit or beyond a particular limit, my dear lovable students, automatically the person who are providing the debt to you will start fear and even they will also start reacting. Even KD will also increase. So KD is not constant, it is variable. Surely when you are injecting more and more and more debt into the capital structure, automatically the fear of the equity shareholder increases and automatically KE also increases. So KD increases, KE increases, automatically KO increases. So if the KO changes, it will be a theory of relevance, because if the KO changes, value of the firm changes. I believe that you are able to appreciate or understand, or what I'm talking with you, you are in a pakka following. If that is the case, you have to try all the question now, man. Now coming to the Modigliani and Miller approach, approach. This is a Nobel Prize winning approach, which is saying that no, sir, the theory, it is a theory of irrelevance, sir. It is a theory of irrelevance, sir. As explained without tax and with tax, my dear lovable students. This we have done, sir. NA approach we have done, and the net NOI approach we have done, and Modigliani and Miller is the last pending. We'll be completing Modigliani and Miller. Modigliani and Miller is saying that first, what he is trying to say is, sir, the firm classified into two categories. One is levered firm, another is unlevered firm. What he is saying that the value of the firm classified into two categories. This is what the basic proposition of the Modigliani and Miller. One is levered firm and other is the unlevered firm. Okay, levered firm means inside the capital structure debt is there. Unlevered firm means inside the capital structure there is no debt, my dear lovable students. If the firm is a levered firm, my dear lovable students, sir, always the value of the levered firm will be value of the unlevered firm plus the tax benefit, plus the tax benefit. This is the first formula the Modigliani has proposed to this world. There is a value of the levered firm. Value of the levered firm is equal to value of the unlevered firm plus the tax benefit, because of debt inside the capital structure. What the is giving the proposition that first you have to classify the firm into two categories, my dear lovable students, as per approach. One is levered firm and other is unlevered firm. If the firm is a levered firm, that means in your capital structure, what will be there? Debt will be there. If there is debt inside the capital structure, from the EBIT, you are supposed to pay interest, correct? So you will be having only EBT. On this EBT only you will be paying tax. But a firm does not have the debt in the capital structure, automatically they will also have the same EBIT, but they will not pay any interest. So automatically the EBIT, earnings before tax, for the unlevered firm will be more than the levered firm. So surely they are liable to pay more tax to the government, whereas levered firm is not liable to pay more tax to the government. They are supposed to pay only less tax to the government. Are you getting it what I am talking to you? So the cash outflow of a levered firm will be less as compared to the cash outflow of an unlevered firm. So automatically the balance money available with the levered firm will be more as compared to the balance money available with an unlevered firm. So that money will be distributed to the investor of the levered firm. So automatically the wealth of the levered firm will be more as compared to the wealth of an unlevered firm. So Modigliani and Miller is saying that, first of all, you understand one thing in this world. Two types of firm are there. Number one is levered firm and unlevered firm. My dear lovable students, the value of an levered firm is equal to value of the levered firm plus tax benefit. And cost of equity in a levered firm is equal to, sir, cost of equity in an unlevered firm plus, sir, if it is same, it should not be same. Why? Why it will not be same? The reason is very simple. Because in the unlevered firm, there is no debt. So there is no risk. So the expectation of the equity shareholder in the unlevered firm will be less as compared to the expectation of the equity shareholder in the levered firm. So cost of the equity shareholder of an unlevered firm plus they are taking some risk. What risk they are taking? The cost of equity in the unlevered firm minus KD into the based upon the proportion of beta, there, sir, KE or the cost of equity will be changing. So WACC in a levered firm is equal to WACC, the KO in a levered firm is nothing but, sir, KE, cost of equity in an unlevered firm, into 1 minus TL. I will be showing you very quickly one example to make you understand what this, sir, Modigliani and Miller is all about. When the value of the levered firm is more than the value of the unlevered firm is the question. Fine. Sir, this is how they will be asking the question. There are two companies, one is N Limited and M Limited. Okay, two companies are there, man. One company is N Limited and other is what? EM Limited. Okay, fine. Having same earnings before interest and tax, EBIT of 20,000. If the earnings EBIT same only, I'll be discussing this chapter, because when two companies are alike in all aspects, right? So the EBIT is 20,000 and here also 20,000. Fantastic, sir. M Limited is a levered company, my dear lovable students. This is a levered firm having a debt of 1 lakh rupees in their capital structure at the rate of 7%. So 1 lakh into 7% come to 7,000 rupees they are supposed to pay as interest. The rate of interest. The cost of equity of N Limited is, sir, 10%. So their KE is equal to 10%. Super. And of M Limited is 11.5%. So we are having two companies, man. There are two companies, N Limited, M Limited, same earnings before interest and tax. M Limited is a levered firm. So if this is N and M, whatever it may be, we have to tabulate. They have tabulated here. Sir, look at here, man. M limited and N limited. Fine. What is the EBIT? Both are having EBIT of 20,000 and 20,000. What is the debt? Only M limited is a levered firm. So only in the capital structure of the M, they will be having debt. Sir, KE is 11.5 and 10%. Sir, why here KE is 11.5? Because M limited is a levered firm. Always the KE of the levered firm will be high. Why? Because they are having debt inside the capital structure. Since they are having debt inside the capital structure, they will be having fear. They need more. They are taking some risk. So surely they will be expecting more return, right, sir? And here KD is equal to how much percentage? 7%. So I have to calculate the value of the equity. Value of the equity is nothing but this company will be earning EBIT. From that EBIT, the company will be paying interest. So you will be getting the earnings available to the equity shareholders. The company has totally earned 20,000 rupees. Out of 20,000 rupees, 7,000 rupees should be shared by the company to the debt holders. So balance 13,000 rupees will be available to the equity shareholders. And the expectation of the equity shareholders in this company is 11.5%. Are you all really with me? So the value of the equity will be 1,13,043 and value of debt, which is nothing but value of market value of debt is equal to, sir, I by KD, and the debt holders will be getting 7,000 rupees, right, sir? Yes, sir. So 7,000 rupees. So 7,000 rupees divided by KD. KD has not been, sir, 7% is the KD. You will be getting the market value of the debt. If you want the market value of the firm, total of market value of the firm, which is nothing but market value of equity plus market value of debt. What is the market value of equity? 1,13,043. What is the market value of the debt? They themselves given in the question, they are having a debt of how much lakh rupees, man? 1 lakh rupees is the debt. So market value of the debt will be how much lakhs? 1 lakh. So 1,13,043 plus 1 lakh rupees debt comes to 2,13,043, and the total, sir, value of the N is equal to 20,000 is the EBIT, right, sir? Divided by KO. What is the KO, man? KO of the unlevered firm will be 10%. This is the value of the equity, sir, of the other company, unlevered firm, which is nothing but 20,000 divided by 10%. Why? Because for an unlevered firm, 20,000 can be fully enjoyed by the equity shareholders. So their KO is equal to KE, simple. So 2 lakh rupees is the value. Are you getting it? Now, how the arbitrage process will be working? Arbitrage process means shifting from one place to another place to get more and more, sir, benefit. This is called as arbitrage process. Very simple, man. They themselves assuming an example. If you have 10% shares in M Limited, you tell me there are two companies are there, M Limited and N Limited, right, sir? M Limited is a levered firm and N Limited is an unlevered firm. That means inside M Limited, you are having debt component, whereas inside N Limited, you don't have debt component, right, sir? My dear lovable students, sir, if you have 10% shares of M Limited, assume that you are keeping 10% shares in the levered firm. Your value of investment in equity shares will be 10% of 1,13,043 because value of equity in the levered firm is this much. In this, you are assuming that 10% you are holding, and return will be, sir, this company will be earning how much? 20,000 as EBIT. Out of that, 7,000 will be paid to the debt holders as interest. Balance 13,000 will be there. On this 13,000, you will be earning 1,300 rupees will be your present or current status, right? So this is the arbitrage process. The alternate strategy will be what you are supposed to do is, now you are in levered firm, you are holding 10% of the levered firm. Now you have to sell that in the levered firm and you have to move into the unlevered firm. So sell your 10% shares of the levered firm for 11,304.30. Better you sell it. Better you sell it in the levered firm and borrow 10% of the levered firm debt of rupees 10,000, which is nothing but what is the total debt of the levered firm? 1 lakh. So 1 lakh into 10,000 come to what? Sir, 10,000. Sir, and invest the money of 10% in the unlevered firm stock. Why, sir? Why I have to borrow? What is the logic in borrowing? Because now you are in the levered firm, right, sir? Assuming that you are holding 10% equity of the levered firm, you are not holding 10% of the total of the levered firm. You are only holding equity of the levered firm. And by selling, you are going to shift to the 10% of the unlevered firm. There, 10% of the unlevered firm means both debt and equity. I know that there is no debt. But if you are keeping 10% of the unlevered firm means total company into 10% you are keeping. But here you are not keeping 10% of the company. You are only holding 10% of the equity. So if you want to hold in the unlevered firm 10%, it should be 10% of the equity plus 10% of the debt in the levered firm. Are you getting it, the concept? So my dear lovable students, to that amount, to the equal amount, you are supposed to borrow money here. So what you are supposed to do? First you, sir, sell. Very simple, sir. First, you have to sell whatever investment you are having in the levered firm. Then you have to borrow. borrow, sir, whatever the equivalent 10% of the levered firm, then you have to invest. This is called as SBI. This is the shortcut, SBI. Sell it, borrow it, and invest it. Sell it, borrow it, and invest it. That's it. So total resource or money we have will be, by selling the equity share, you will be having 11,030.30, right, sir? And by borrowing, you'll be having 10,000. Totally 21,304.3 will be there in your pocket. And you invest 10% of 2 lakh. What is that 2 lakh? That is the value of the unlevered form, right, sir? So you need only 20,000 rupees. Fine. So extra, you'll be having 1,304.3. With this, you can go to some shop and you can enjoy, have ice cream, eat it. That's what Modigliani and Miller is saying. Sir, by doing this, will my return change? No, that's what arbitrage process is all about. Your return will be 10% of the EBAT of the unlevered form, right? So in the unlevered form, you'll be getting 10% minus interest to be paid to the borrowed fund. In that unlevered form, there is no interest at all. So they are earning 20,000. So 20,000 into 10% comes to, you will be getting 2,000, my dear lovable students. So you will be getting net income of how much? 2,000, because in the unlevered firm, there is no debt at all. So whatever EBAT they are earning, that into how much percent you will be getting? 10% you will be getting. So 20,000 to 10% come to 2,000. But you have borrowed money. You have borrowed money to the extent of 10% of the levered firm. How much you have borrowed, my dear lovable students? 10,000 you have borrowed. For that, what is the KD of that levered firm? 7%. So you are supposed to pay 7%. So 10,000 into 7% come to 700. So you will be getting 2,000 rupees from the unlevered firm, and you are supposed to pay 700 to the borrowing amount. So balance available money will be with me 1,300. When you were in the levered firm also, your total return was 1,300. So when you are in levered firm, you got 1,300. When you arbitrate, shifted to Towel to the unlevered firm, then also you got 1,300. So what the Modigliani and Miller is saying, that, my dear lovable students, automatically people will start or shift from the levered firm to the unlevered firm. So by this process is called as arbitrage process. Because of arbitrage process, economics will start to work. How economics will start work? I will tell you. This is what the proposition of Modigliani and Miller. So Modigliani and Miller are super fantastic, sir. Explanation. They are saying that, first of all, understand that there are two types of firms are there. One is levered firm and other is unlevered firm. Levered firm means in the capital structure debt is there, and unlevered firm means in the capital structure there is no debt. Comfortable? Clear? So always the value of the levered firm will be more than the value of the unlevered firm, and value of the unlevered firm will be less than the value of the levered firm. The reason is very simple. This, because of debt in the capital structure of the levered firm, they can debit the interest to the P&L account. Because of debiting the interest to the P&L account, automatically the net profit reduces. So they are supposed to pay only less tax. So automatically the balance available with the levered firm will be much more than the balance available with the unlevered firm. So they can distribute that much amount of money to their investors, whereas unlevered firm can't distribute that much money to the investor. So automatically, my dear lovable students, sir, fantastically the Modigliani and Miller is saying that the value of the levered firm will be equal to the value of the unlevered firm. Don't think like that. If tax is there, if no tax is there, value of the levered firm is equal to value of the unlevered firm. Okay, fine, fantastic to the core. But if there is no tax, my dear lovable students, the value of the levered firm will never be equal to the value of the unlevered firm. Sir, if there is tax, value of the levered firm will be more than, sir, the value of the unlevered firm. That's what they are saying. The value of the levered firm is equal to value of the unlevered firm plus sir, DT, which is nothing but debt into tax. This will be the value. This will be the value. And so he make a proposition that initially value of the levered firm will be what? More. And value of the unlevered firm will be what? Lesser. So from here the investor will be getting some return, and here the investor will be getting some return, right? What the investor will be start doing is they will start sell from the levered firm, and they will borrow the equivalent debt in the levered firm, and they will start invest in the unlevered firm, my dear lovable students. So what will happen? The investor is getting same amount of return. Just now I proved that 1,300 whether you are in the levered firm or unlevered firm, right? Fantastic. So my dear lovable students, so let me ask you a very simple question. When everyone start sell the shares of the levered firm, everyone start sell the shares of the levered firm, and everyone start buying the shares of the unlevered firm because of the same return, automatically the supply of the levered firm increases and demand of the unlevered firm increases, right, sir? Fantastic, sir. So automatically the supply and demand, the economics will start to work. So everyone is start selling the shares of the levered firm. So now this is overpriced. So whenever people start selling, the price reduces. And the price of the unlevered firm is less as compared to the price of the levered firm. Everyone start buying. Automatically the demand increases, automatically the price increases. It will reach an equilibrium price. So automatically at the end, the KO will become constant. This is what Modigliani and Miller is saying, that this theory is also theory of irrelevance. I believe that you are able to appreciate or understand what I am talking to you. That's what they are saying. We will quickly solve, sir, one more illustration. Illustration number 7. Following data is available in respect of two companies having same business risk. Yes, it has to be same business risk. Then only, my dear lovable students, we can compare. Capital employed 2 lakh, both the company 2 lakh. EBAT 30,000, both the company 30,000. KE 12.5%. I can't say both the company KE 12.5%. Right, sir? Sir, this is levered company details and this is unlevered company details. Debt 1 lakh, 1 lakh. Surely, since there is debt in the capital structure, that is why we are calling it as levered company. Here, debt will not be there. Entire 2 lakh will be represented by equity. An investor is holding 15% shares in levered company. Calculate the increase in annual earning of investor if he switches his holdings from levered firm to the unlevered firm. Fine. So they are asking you to do an arbitrage. That means the investor has to go from the levered firm to the unlevered firm. Shall we quickly go through? Be with me. This is levered firm and this is unlevered firm. What is the EBAT? 30,000, 30,000. Why is the same EBAT? Because if two firms are alike in all aspects, fine. The less interest on debt. 1 lakh into 10%, very simple. They are liable to pay interest, man, but this guy is not liable to pay interest. So what is the earnings available to equity shareholders? 20,000 and 30,000, right? What is the KE? Sir, since no other information has been given, we are assuming that both the companies having same KE, but we won't have same KE because in the levered firm, debt will be there. Sir, if debt is there, the risk to the equity shareholders are high, right? So I'm assuming that the KE of the levered firm is equal to KE of the unlevered firm. No other information has been given in the question. So value of equity, I can find out the value of equity, which is nothing but, man, value of equity is earnings available to the equity shareholders, which has 20,000 rupees is the value available to the equity shareholders. You can take your calculator, man. 20,000 divided by 12.5% come to 1,60,000 rupees is the value of equity. Getting it, sir. Fantastic, sir. Whereas with regard to unlevered firm, my dear lovable students, unlevered firm, the earnings available to the equity shareholders are 30,000 and their expected rate of return is 12.5%. So 2,40,000 rupees is the value of the unlevered firm. Here the value of equity is equal to value of the unlevered firm because in unlevered firm only equity are there. Whereas in levered firm, you have to add the value of what also? Debt also, which comes to 1 lakh. So the total value of the levered firm is 2,60,000. Whereas the value of the unlevered firm is 2,40,000. Look at here, my dear lovable students. Surely, the value of the levered firm will be more as compared to value of the unlevered firm. What you are supposed to do? Now you have to shift from the levered firm to the unlevered firm. So the value of levered firm is more than that of the what firm? Unlevered firm. Therefore, investor will sell his share in the levered company. First, you have to do the what, man? Sell. Then you have to borrow. Then you have to invest. That's it, man. And buy shares in unlevered company. To maintain the level of risk, he will borrow proportionate amount and invest that amount also in the shares of the what company? Unlevered company. Why I am borrowing? I already said the logic. Because in the levered firm, I have not kept 10% of the total levered firm. I was holding only 10% of the equity. But now I'm going to hold the 10% in the unlevered firm. That means I have to borrow 10% proportionate to debt of the levered firm. Then only I can match with the 10% of the unlevered firm. Fantastic to the course, sir. I believe that you are able to appreciate or understand. So investment and borrowing. First, sell the shares in the levered company. 1,60,000 into 15% come to 24,000. This you have done the sell. Then you have to borrow money. Sir, proportionate debt has to be borrowed. So 1 lakh into 15% come to 15,000 you have to borrow, my dear lovable students. And so total 24,000 plus 15,000, totally 39,000 rupees will be there with you. You can buy the 39,000 rupees value in the unlevered firm. So I'm going to find out the change in return. It's not like earlier thing. I have not went to shop and I don't have ice cream because the whatever entire money available with me, I have invested in the unlevered firm, right, sir? So income from shares in unlevered firm. Now I'm holding 39%. What is the KE of the unlevered firm? 12.5%. That is the KO of the unlevered firm. Why? Because in unlevered firm, KE is equal to KO because it's an all equity company. Clarity. So 39,000 into 12% come to 4,875. So that company will pay me 4,875 rupees. From that, I have already borrowed some what? Debt. So 15,000 rupees is what I have borrowed, my dear lovable students. So 15,000 into 10% come to 1,500 rupees is what I have to pay interest from my pocket. So the net income from the unlevered firm will be 3,375. But earlier, when I was a shareholder in the levered firm, sir, 24,000 rupees is what the earnings available to the equity shareholders. On that, I was entitled to get 12.5%. I was getting 3%. That's its incremental, sir, due to arbitrage is 375 rupees extra I will be getting, my dear lovable students. That's it. In order to enjoy this extra 375 rupees only, I have shifted from the levered form to the unlevered form. With this, sir, you can try illustration number 8. That is again a Modigliani and Miller approach only. Again, arbitrage process, my dear lovable students. Again, illustration number 9. The similar discussions are only making there. And even illustration number 10. Now itself you can go through and you can complete this part. These are the 4 theories, man. Number 1, sir, NI approach, NOI approach, traditional approach, and Modigliani and Miller approach. In that Modigliani and Miller, arbitrage process may be tested in examination. Spend your 1 hour of time here. I believe that, sir, I am making some value addition to you, to your preparation for the coming examination. If yes, I want to know by way of comments, because if that is the quickest and the biggest motivation for me to do more and more and more revision videos for you, my dear lovable students, I'm wishing you all the very best. Until by this, we have done with the leverage analysis, we have done with the ratio analysis, we have done with the cost of capital, and we have done with the capital structure theories. I just want to know which is the next chapter you want in the comment section. Thank you and bye-bye for me. I believe that your preparations are going very good, my dear lovable students. This we are doing as a series of FM revision videos. In that we have done with the leverage analysis, we have done with the ratio analysis, we have done with the cost of capital, and also the capital structure theory. Immediately after the capital structure theory, we are supposed to do the next chapter called as dividend decision. Why dividend decision? Because both the chapter are talking about same things. What the capital structure theories are saying, if two companies are alike in all aspects except capital structure, will the value of the firm change or not is the question. Yes, the value of the firm change is called as theory of relevance. No, the value of the firm will not change is called as theory of irrelevance. We are having two theory of relevance, which is by one is called as NI approach, net income approach, and traditional approach. Whereas two theories are saying that no, because of just change in the capital structure, the value of the firm will not change. That is what theory of irrelevance, my dear lovable students, which has been proposed by NOI approach and the Modigliani and Miller approach. The same question only we are going to answer even in the dividend decision. What we are going to talk in dividend decisions is, my dear lovable students, if two firms are alike in all aspects except dividend policy, will the value of the firm change or not is the question. That means there are two companies are there. One company is called as A Limited and other company is called as N Limited. This company A Limited is giving dividend, whereas N Limited is not giving dividend. Because of this, will the value of the firm change or not is the question. Yes, the value of the firm will change. That is what theory of relevance. And no, the value of the firm will not change is what theory of irrelevance. So these are the things we are going to be talked in this chapter. Very quick discussion we are going to make. So my dear lovable students, as we all know that sales minus variable cost will give us contribution. From that, if you reduce fixed cost, we will be getting EBIT. From the EBIT, earnings before interest and tax, we have to pay the interest. We will be getting the profit before tax. From this, we have to pay the tax, my dear lovable students. If we pay the tax, we will be getting the PAT, which is profit after tax. So from this profit after tax, we will be surely distributing the preference dividend. We will be getting residual earnings. Sir, that residual earnings we can declare as dividend. If we are distributing the residual earnings, that is called as dividend. If we are retaining that amount, that is called as retained earnings. What is the logic of this? Why I have to retain instead of distributing is the question. My dear lovable students, if I have some project in the pipeline, so I need surely money. The company surely need money. So instead of raising from the outside market, it's better to use the internal source of finance. So dividend is an internal source of finance. Why? What is the specialty? If I am using the internal source of finance, no need to worry about the flotation cost. Otherwise, the company has to bear the flotation cost. Surely it will shoot up the cost of capital, and surely the company will be having such added more pressure, because once the denominator net proceeds reduces, the cost of capital increases. I hope that you are able to understand what I am talking to you. So my dear lovable students, long-term financing decision. Equity can be raised externally through issue of equity share, or can be generated internally through retained earnings. But the retained earnings are preferable because they do not involve flotation cost. There is no flotation cost for the retained earnings. But as a company, we have to incur the flotation cost for the fresh issue. So surely it will increase as the denominator, and automatically the cost of capital will increase us. So my dear lovable students, this chapter is teaching us, saying that whether we have to give the dividend or not is the discussion. So our ultimate objective of this chapter is, we are having theories of dividend. What is the fight we are having? If two companies are alike in all aspects except dividend policy, will the value of the firm change or not is the question. No, the value of the firm will not change. That is called as irrelevance theory. The dividend is irrelevant as per approach. Even in the capital structure theory also, the same guy is having something to say. He said that, sir, levered firm, unlevered firm, the value of the levered firm will never be equal to the value of the unlevered firm if the tax exists. If there is tax, the value of the levered firm will be much more than the value of the unlevered firm because of the tax effect of the debt we have discussed. And we will be doing a process called as arbitrage. Because of the primary arbitrage, people will start selling the shares in the levered firm and they will start purchasing the shares of the unlevered firm. Automatically, the demand of the unlevered firm increases. Automatically, the price of the unlevered firm increases. It will reach an equilibrium price. This is what primary arbitrage is all about. Hope you are able to appreciate. The same Modigliani and Miller is coming and saying that, no man, if everything is same, if two companies are alike in all aspects except dividend policy, because of that, the value of the firm will not change, is what their assumption or is what their proposition is all about. What this they have said that they have, sir, proved by way of formula, which we already know, that price of the share. You tell me the current market price, which is MPS 0 of a share. So today you are going to purchase a MAD. Based upon what you will be paying, sir, purchasing the MAD, it's based upon how much PAL it will be giving. That is called as DPS1. Plus, when you are selling that MAD after 1 or 2 years, what price you will be getting? That is called as MPS1 divided by. You will be having certain expectation. This PAL and this price should be either 10% or 15%. That is the expectation of the equity shareholder. That's what 1 plus KE. So what Modigliani and Miller is saying, that the price what you will be paying to an equity share will be its future cash flow, present value of its future cash flow, correct? What are the future cash flow from that equity share? Sir, you will be getting dividend, first point number 1, that is dividend DPS number 1. And also you will be selling the share after a certain point of time, that is after end of the first year. So you will be getting MPS 1, my dear lovable students. That's what DPS 1 plus MPS 1 divided by 1 plus KE, which is nothing but, sir, I am just bringing the future cash flows into the present value. That is called as MPS 0. This is what the Modigliani and Miller said. And as per hypothesis, value of firm will remain unchanged due to the dividend decision. Whether you pay the dividend, don't pay the dividend, the value of the firm is going to be one and the same. Sir, this is how you have to calculate the total value of the firm, which is nothing but N, which is number of shares in the beginning of the period. How many number of shares you are having, plus, sir, new number of shares issued to raise the fund required. For example, in order to do a new project, you may have short of fund. That short of fund you will be raising by issuing the new equity. So automatically the number of equity shares increases, my dear lovable students, into, sir, price, which is MPS. This is the total number of equity shares will be available with the company. This into P1. P1 in the sense means, sir, MPS 1. Minus, sir, investment, sir, amount required for the investment, that will be cash outflow, plus whatever amount will be with you as the earnings, divided by 1 plus KE to bring that to the present value. So this is what the formula. In order to make you understand this in a very better way, I'll be quickly revising illustration number 1 for the time being. And this question or illustration is very important. From this chapter, we have to mandatorily go through. ABC Engineering Limited belongs to a risk class for which capitalization rate is 10%. That means KE is equal to how much percent? 10%. It currently has outstanding 10,000 shares, selling at 100 each. Now the company is having 10,000 shares. The firm is contemplating the declaration of dividend of 5 per share at the end of the current financial year. The firm wants to issue 5 per share as dividend. It expected to have a net income of 1 lakh and as a proposal to making new investment for 2 lakh. So they are going to do a new project where 2 lakh rupees is the required money, but they are having 1 lakh rupees with them. Fine. Calculate the value of the firm when dividend are not paid or dividend are paid. So MM is going to prove that when dividend has not been paid, what will be the value of the company? When dividend has been paid, what will be the value of the company? Comfortable, sir? So case number one, when the value of the firm, when dividend are not paid. So this is situation number one. Will be quickly revised, man. Sir, calculate the price at the end of the period. Sir, they have given that KE is equal to 10% and MPS 0 is equal to 100 and DPS 1 is equal to 0. Why DPS 1 is equal to 0? Because the company is not going to issue any dividend. So MPS 0 is equal to current, sir, price of an asset is equal to present value of its future cash inflow. What are the inflows from an asset? Sir, you will be getting DPS 1, that will be the future cash inflow, and plus you will be getting MPS 1. So these are the future cash inflow divided by, sir, you have to do the present value factor, that is KE is the present value factor for an equity. So the present value P0 is equal to 100 plus you don't know MPS 1. So that has to be taken as X and you don't have the DPS 1 divided by 1 plus 1.1. So which is nothing but 1.1. So 100 into 1.1 means you can pay, sir, after 1 year, it will grow at a rate of 110. That means at the end of the first year, the share price will be how much, man? 110. So now step number 2, calculation of the fund required for the investment. You itself tell me how much you have earned. Sir, 1 lakh rupees you have earned. What is the dividend distributed? Nothing has been distributed as dividend. So fund available for investment is how much? Lakh? 1 lakh. You can maximum, sir, invest is how much? Lakh? 1 lakh. So total investment is how much? Lakh? 2 lakhs, my dear lovable students. Sir, total, out of total investment of 2 lakh, we are having fund available of how much? Lakh? 1 lakh. So 2 lakh minus 1 lakh means 1 lakh has to be further raised by way of, sir, issue of new equity share, right, sir? Sir, now you know that MPS 1 is equal to, sir, 110. This will be the price after its growth. So I need to raise 1 lakh share. So 1 lakh rupees. So 1 lakh divided by 110 means I have to issue N number of equity shares, right, sir? So 1 lakh divided by 110 comes to, I have to issue 909.09 number of shares. So already I am having 10,000 shares, right, sir? I have to issue the number of shares, which is nothing but 1 lakh divided by 110. So I'll be getting some number of X number of equity shares I have to issue into, my dear lovable students. Sir, 110 will be the market price at the end of the year. So I'll be getting the total value of the firm, which is nothing but number of equity shares in hand into market price per share will be my total value of the firm. Hope you are able to appreciate or understand. Sir, this will be the wealth available with me, right, sir? So 10,000 number of shares I am having. I will be issuing 909.09 shares also. So total number of shares will be this plus this into this number of shares will be with me at the end of the first year. So into 110 will be the value of the firm, my dear lovable students. But this much money I will not be having because out of this much, sir, wealth I am having, 2 lakh rupees I have to invest. So 2 lakh rupees will go out and I will be earning 1 lakh rupees. So the net outflow will be 1 lakh rupees, right, sir? Divided by 1.1. So these all are in future cash inflows. So I have to bring that to the present value. So that now the value of the firm comes to 10 lakh is the value of the firm if they are not paying the dividend. So MM is saying that take this as an example. If the company is not going to issue as dividend, so 10 lakh rupees will be the value of the firm. Okay, fine. So case number 2, when the value of the firm, when the dividend are paid, you take it value of the firm as dividend as paid. What is the formula? So the present value of that is MPS 0 of an equity share is nothing but, for example, you are going to purchase a mad. Sir, how much value you will give for a mad? It based upon how much pal it is going to give. DPS 1 is the pal. And after 1 year, if you sell the mad, you will be getting MPS 1, right, sir? These are the future cash inflows. You will be discounting that future cash inflow to today because that is future value. So present value of its future cash inflow is the value of the asset today, right, sir? That's why DPS 1 plus MPS 1 divided by 1 plus KE, my dear lovable students. So if you are declaring dividend, I know today's value of an asset is 100 rupees, right? And I don't know for how much rupees it has to be sold in future. That is what MPS 1 plus 5 rupees is the dividend divided by 1.1. So MPS 1 is equal to 105. That means it has to be grown at 105.
Now, what is the fund required for the investment? So earnings is equal to how much lakh? 1 lakh. You have earned 1 lakh. But to do, and out of this 1 lakh, my dear lovable students, how much equity shares you are having? Totally 10,000 equity shares. For every shares, you are declaring 5 rupees dividend. So 10,000 into 5 comes to how much? 50,000. So out of this 1 lakh, 50,000 you have distributed as dividend. Only balance 50,000 will be with you. But you need 2 lakh rupees to do the project. So 2 lakh rupees minus 1 lakh 50,000 means you need 1 lakh 50,000 has to be raised by way of fresh issue, right, sir? So 1 lakh 50,000 divided by 105 will be the MPS 1. Are you really with me? So this has to be raised by way of, my dear lovable students, sir, number of equity shares. Very simple. Already you are having 10,000 equity shares with you. So 1 lakh 50,000 divided by 105 will be the new equity share will be issuing for the purpose of doing the project. So you'll be getting the total number of equity shares. You just tell me what is the general value of the firm. Value of the firm is equal to number of equity shares into market price per share, right, sir? This number of equity share you have taken on 31st of March. This is the number of equity share into market value also should be from 31st of March. Then you will be getting the, sir, total. But out of this 2 lakh rupees you are going to invest, so it will go out and 1 lakh rupees is going to come in. So I have to minus 2 lakh rupees and plus 1 lakh rupees divided by, so this all are in future value. So I have to bring that to the present value divided by 1.1. That means 10 lakh. That means what Modigliani and Miller is saying, that if two companies are alike in all aspects, irrespective of the what dividend policy what they are having, value of the firm will not change. Value of the firm will not change, my dear lovable students. That's what is saying. That this is what proved here, sir. The MPS 0, that is the value, present value of an equity share is equal to, which is nothing but, my dear lovable students, MPS 1 plus DPS 1 divided by 1 plus KE. What is MPS 1? MPS 1 means a share price at the end of the first year. DPS 1, what dividend I will be getting at the end of the first year, which is nothing but future cash flows divided by, sir, I want present date. That means I have to discount the future cash flow by using a discounting factor. If it is in capital budgeting, what I will be taking? I will be taking cash flow into present value factor at some percentage, right, sir? I will be getting the discounted cash flow. Discounted cash flow will be today's rate, right, sir? So from the future date, if I am going here, I will be multiplying, but I am going to come, sir, I want the future date, not the present value. So if future values available with me, so I will be dividing instead of multiplying. That's why 1 plus KE. And price of a share is calculated as below. The value of the firm is equal to total number of shares already you are having, that is N, plus the additional share whatever you have issued. So you will be getting the number of equity shares, right, sir? Into, my dear lovable students, sir, what is the MPS 1? Because number of equity shares into share price will give you the total wealth of the company, minus you would have invested something, that will be a cash outflow, plus you would have earned something, that is a cash inflow. So net cash outflow divided by, because that will be happening in future, to the present date, the value of the firm will be 1 plus KE. That is what the quick analysis of the MM approach. So MM will fall under the category of, my dear lovable students, theory of irrelevance. I hope that you have understood. Very quick, we are having two more, man. One is called as Walter's model and Gordon's model. Walter and Gordon is saying that, oh my God, if two companies are alike in all aspects except capital structure, sir, and except dividend decision, their value of the firm will change, is what the Walter is saying. Walter is saying that the price of a market price of a share today is based upon, sir, its future cash inflow, same, which is nothing but D. D stands for what? Dividend. Plus, sir, E minus D. What Walter is asking is, if 10 rupees is what earnings of the company and dividend they are declaring as 6, the retained earnings of the company will be 4. That's what E minus D. E minus D means 10 minus 6. That means 4 rupees the company is retaining. So you tell me what this, with this 4 rupees, what the company will do? They will be investing in certain project, and surely that investment will be earn certain return. It will grow certain return, right, sir? So that retention will grow in certain rate. That's why into R. So 10 rupees company earned, 6 rupees declared as dividend. So 4 rupees is a balance. That 4 rupees company will invest and they will generate certain return. That's what R. Sir, will this happen now or in future? The growth will come only in the future. So you have to bring that to the present value. That is what divided by KE. Super, sir. And whole divided by KE in the sense means this is not going to be happen for 1 year. This is going to be happen for every year. So this is a perpetual cash flow. For a perpetual cash flow, I will be divided by KE. I will be doing cash flow divided by R will be the present value for a perpetual cash flow. So, sir, with regard to My dear lovable students, Gordon's Walter's model, sir, MPS 0 is equal to DPS 1. This is DPS 1 is one form of return plus R by KE into E minus D, or rather E minus D into R by KE. Whole divided by KE will be the market price. Are you all really with me? So Walter is, sir, saying that very simple. You have to check whether your company is a growth company, constant company, or decline company. This is what you are supposed to check, whether you have to compare your R with KE, my dear lovable students. Your KE is, for example, sir, 15%. That means equity shares are expecting 15%. But sir, if you are keeping the money with the company instead of giving it as a dividend, the company can generate 20%, means it's better to keep with the company and earn an R of how much percentage? 20%. So, if this is the scenario, if R is more than KE, what Walter is saying that, sir, 0 rupees should be given as dividend. You are not supposed to give any amount as dividend because it's better to hold by the company to make more wealth to the equity shareholders. Now, constants are, if R is equal to KE, that means here also 15% and here also 15%, no correlation. Every payout ratio is optimum. What Walter is saying that if you want, you pay 0%, if you want, you pay 100%, whatever you want, you do. We don't have any problem. But if the R is less than KE, for example, so the equity shareholders are expecting 15%, but if we are holding inside the company, we'll be able to generate only a return of 10%. Please, 100%, whatever earnings is there, 100% you give it to the shareholders. They let them invest somewhere and let them earn more rate of return. This is what the, sir, analysis of the Walter. Walter is saying that I'm so much extremist. That means either I will be giving 100% dividend or I will ask you to say 50%, 0% dividend. But sir, my dear lovable students, the MM is saying that irrespective of the dividend, whatever you have paid, my dear lovable students, the value of the firm is not going to change. But Walter is saying that it's not like that. The value of the firm will change if you pay dividend or not pay dividend, because based upon this only you have to take a decision that whether you have to pay the dividend or not. So, if this company, for example, if the R is less than KE, the equity shareholders are expecting 15% and the rate of return is only 10%. If such company, instead of not giving dividend, if they are holding their money with the company, surely the company's value will go down. Are you really with me? So, it's better to give 100% of the dividend, then only the company's growth rate will be more. So, here, if this company has wrongly given us dividend, the first case, my dear lovable students, because the expectation of the equity shareholders are only 15%, but company will be able to generate a return of 20%. It's better to not give any dividend. So in that case, if they are giving dividend, automatically the earning capacity of the company reduces and also the value of the company reduces, man. This is what the Walter's model is all about. So Walter is saying that, sir, MPS 0, the P0 is equal to DPS 1, D plus R by KE into E minus D whole divided by KE. So Walter is classifying the future cash flows into two categories. One is surely dividend, there is no doubt about it, and is considering the growth rate also, my dear lovable students, which is the company will earn earnings, out of that company will distributing dividend, the balance will be the retained earnings that will be invested by the company in some project, they will be earning some return. That's what R, that will be in future, so that has to be brought to the present value divided by KE, and this dividend and this return every year it will be rotating. So this is the perpetual cash flow. For present value of perpetual cash flow is nothing but cash flow divided by R. So this is the cash flow totally. For that, again divided by KE will give the present value of the present value, that is P0 of the asset. Fantastic to the core. Gordon also saying that the same thing in a different way. What Gordon model is saying that yes, if two companies are alike in all aspects except dividend policy, if they are having different dividend, my dear lovable students, the value of the firm will change. But what Gordon is saying that, sir, the MPS 0, the market price of a share is equal to, sir, E1 into 1 minus B, which is nothing but E1 means EPS 1. Out of EPS 1, sir, you will be having 1 minus B. B stands for balance retention ratio, right, sir? Sir, 1 minus balance means 100 minus retention. You will be getting the dividend payout ratio. So E1, EPS 1 into dividend payout ratio, you will be getting the DPS 1. Are you all really with me? Which is nothing but DPS 1 whole divided by KE minus, sir, BR into G. Sir, B into R into G, which is nothing but what? Growth rate. What Gordon is saying that already we have studied the Gordon in the cost of capital. There he said that KE is equal to DPS 1 divided by MPS 0 plus G. Right. Fantastic to the core. The same thing only. This plus G has been brought here, man. So it has become KE minus G is equal to DPS 1 divided by MPS 0. Are you getting it? Here, I want to find out the MPS 0 only, my dear lovable students. So MPS 0 is equal to DPS 1 divided by KE minus G, which is nothing but this DPS 1 is nothing but whatever price you are earning, that is earnings into 1 minus B. B stands for your retention balance. So 1 minus B means your dividend payout ratio. So EPS 1 into dividend payout ratio divided by KE minus BR into G. This is what your current market price of a share. He is also having the same what Gordon is also saying, that if the R is more than KE, you should not pay 0 rupees dividend, because if the investor is expecting only 15%, my dear lovable students, but company will be able to generate more than 15%, then why are you giving dividend? If such company has given dividend, such company is taking a wrong decision and that company's value will be less. Fantastic to the core. And if the R is equal to K, both Walter and Gordon is saying that there is no optimum payout ratio. If you want, you can pay it 100% or you hold it 100%. Whatever it may be, the value is not going to be changed. If the R is less than KE, even the Gordon is saying that please give 100% of the dividend. Please, company, don't hold in your hands. If you are doing that, you are taking a very wrong decision. Your value will reduce, is what the both Gordon and Walter decision is all about. Fantastic to the core. So these are the maximum dividend decisions, area you will be getting. For example, the next one we have talked about the Walter's model. Market price is equal to D plus R by KE into E minus D whole divided by KE, my dear lovable students. Here we are having the same thing. We have talked about it. Here you can, discuss this question very quickly. X Limited earns rupees 10 per share. So company is earning 10 per share. Capitalization rate and the return on investment are rupees 10 and 12 rupees respectively. Capitalization rate means KE. KE is equal to 10% and return on investment R is equal to 12%. That means equity shareholders are expecting only 10%. And if the company is holding the money, they'll be able to generate a return of 12%. So you itself tell me it's better to hold 100%, right? Determine the optimum dividend payout ratio and price of share at that price. So it's better to don't give anything as dividend. 0 rupees should be the dividend, right, sir? So shall we calculate? If that is the case, my dear lovable students, that is the case, your share price will be maximum. If share price is maximum, my dear lovable students, number of shares into share price per share will be the value of the firm, right? So I always want to have a big number of share price. So my dear lovable students, it is D plus R divided by KE into E minus D whole divided by KE. Dividend, I will not pay 0 rupees as dividend because my R is more than KE and my R will be 0.12. Sir, 10 minus 0, entire 10 rupees I will hold. If I hold 10 rupees, it will at the rate of 12%, it will grow in future only. So I'm bringing that to the present value divided by KE. So total divided by KE, 120 rupees will be the share price. But the same Walter is saying that, sir, neither if you want, you can give 25% payout ratio, no problem at all. That means out of 10 rupees, you give 2.5 rupees as dividend. Balance only 7.5 rupees, you keep it. Then, if you are having only 7.5 rupees, sir, then you are taking a very wrong decision and automatically the share price reduces. If share price reduces, my dear lovable students, number of shares into closing sales value, the value of the firm reduces. This is what the, main agenda of the Walter and also the Gordon. Sir, you have to try, sir, question number 3 and question number 4 and question number 5. So what this chapter is all about, my dear lovable students, this chapter is saying that if two firms are alike in all aspects, except capital structure, except dividend decision, sir, will the value of the firm change or not is the question. Yes, the value of the firm will change as per the Gordon and also the Walter, my dear lovable students. No, if two firms are alike in all aspects, how the value of the firm will change is what the discussion of my dear lovable students. The is saying always MM's propositions are correct. Please go through all the illustration, especially that MM's problem will be tested in examination and also Walter and Gordon, that area's illustration now itself you go through. These are the quick revision of the dividend decision also, my dear lovable students. I believe that your preparations are going very well. If you are feeling confident now, just click the like button and just put a comment that, sir, you are feeling comfortable. That self-realization is one of the most important thing we required. We are going to crack this attempt, my dear lovable students. Any other chapter you need quick revision, just update me by way of comments, because in this last moment of time, I will try my level best to make it for you. Sir, I'm wishing you all the very best. We'll meet as CA final students. Thank you. Bye-bye from me.
Very, very, very happy evening to all. My dear lovable students, we are continuing our quick revision series of financial management. I believe that your preparations are going very well. You know one thing, we have done the revision of leverage analysis. We have done the revision of ratio analysis, cost of capital, capital structure theories, and the dividend decision. We are pending only with capital budgeting and working capital management. In that, my dear lovable students, in this slot, we are going to talk about the capital budgeting, one of the most important topic for examination, capital budgeting. The base for the capital budgeting is nothing but the cost of capital, because I am going to take a decision, investment decision. If you see our subject, my dear lovable students, financial management, we are having three objectives. The three objectives in our subject are, number one, financing decision. Financing decision means we have to raise the fund. That's what the chapter cost of capital and capital structure theories is all about. Number two, after you raise the fund, will you keep the fund idle? No. You will be investing in various places. That's what investment decision. Sir, once you invest, surely we will be getting some return. That return is called as dividend. That is called as dividend decision. These are the three decisions we have to take as a financial head. So, my dear lovable students, this is one of the most important decision, investment decision. After you raise the fund from the equity, after you raise the fund from the debt, after you raise the fund from the preference shareholders, after you raise the fund from the reserves and surplus, you would have surely incurred KE, you would have surely incurred KD, you would have surely incurred KP, and you would have surely incurred KR. The total to total, surely there is a cost to the company, KO. And my dear lovable students, this money you are going to invest in a project, that project should be able to give a return. It should be able to satisfy the KO. That decision we are going to take, called as investment decision. Whether we can invest our money in this particular project or not is what the investment decision is all about. For that, we will be having so many techniques. For example, if you are going to a doctor, my dear lovable students, doctor will, take lot of reports like X-ray, scanning, this, that, and all. He will be analyzing the physical position. Like that, we are having so many capital budgeting technique like payback period. As an auditor, as a financial expert, you have to check the payback period. Payback period in the sense means once I put my money in a particular project, within how much time I will get back, how much time I can recoup the money is what the payback period is all about. Generally, a person will choose a project with low payback period because that's better always for an investor. Within what number of time, how much short span of time, if we are able to recover the money what we have deposited, that is well and good. That's what the payback period is all about. Accounting rate of return, which is the average rate of return. This chapter is mainly talking about analysis of the decision based upon the CFAT, which is cash flow after tax. I will come to what is CFAT, cash flow after tax. That means we will ignore the books of accounts. We will not see the book profit. We will not see the net profit. We will be seeing only the cash flow. The decision is based upon the cash flow. So one of the technique by using the accounting profit is what accounting rate of return. And the most famous thing is NPV, which is net present value, net present value, and the profitability index, and the IRR. And you are having modified IRR and discounted payback period. So this is simple payback period. And we are having discounted payback period. I will explain to you all the technique very quickly. I will make it remember for you for tomorrow's examination. Don't worry at all, my dear lovable students. Now, what are the types of decision making you are going to make on the basis of the firm's existence, on the basis of the decision situation? Sir, already firm is a continuing firm. You'll be taking replacement and modernization decision, expansion decision, and diversification decision. Or on the basis of decision situations are mutually exclusive decision, or accept or reject decision, or contingent decisions. I will come to one by one. This chapter is mainly based upon the analysis of the cash flow, my dear lovable students. What is the analysis of the cash flow? For example, after you raise fund from the equity, debt, preference, and the retained earnings, you are having a capital amount of 50 lakh. This 50 lakh you are going to be invested in a plant and machinery, right, sir? In a plant and machinery, you are going to invest. Whether I can invest this 50 lakhs in that plant and machinery or not is the question. So this chapter is a game of cash flow. What flow? Cash flow. So estimation of the projected cash flow. As a decision maker, first we have to estimate the cash flow. Capital budgeting analysis consider only incremental cash flow, that is additional cash flow from an investment likely to result due to acceptance of any project. Therefore, one of the most important tasks in capital budgeting is estimated future cash flow for a project. That means today you are going to invest 50 lakh. So the present value of the 50 lakhs is 50 lakh. So the cash outflow today is 50 lakh, but the future cash flow is not today. You will be getting the inflow in year number 1, 2, 3, 4 and 5. And after the end of the project, you will be having cash inflow called as salvage value, my dear lovable students. So you have to clearly estimate the cash flows. This is what this chapter is all about. So how to calculate the cash flow is what the question. Calculating cash flow is based upon whether you are charging depreciation or not charging depreciation. If there is depreciation or if there is not depreciation. So based upon the depreciation, the cash flow will change. Number one is total sales. Whether depreciation is there or depreciation is not there, sales value will not change. As we all know that sales is an inflow, my dear lovable students. Sales is an inflow. In order to enjoy that inflow, first we have to manufacture the goods by spending, sir, by making the production. So cost of goods sold is an outflow. Are you all really with me? So sales minus cost of goods sold is my gross profit. Gross profit is my inflow. The balance cash available with me. Sir, from that, if there is, sir, no depreciation, I will not reduce any depreciation. But if I am having any depreciation, I will be reducing the depreciation, my dear lovable students. So you will be getting profit before tax. Profit before tax. So I have not paid the tax. Now I am going to pay the tax. Are you all really with me? So this is what profit before tax and profit before tax. Surely I will be paying tax at the applicable rate. I am assuming that 30% is the tax rate, my dear lovable students. I will be paying tax. So this is a cash outflow. Tax payment is a cash outflow. So I will be having PAT, which is profit after tax. This is the accounting profit and this is the accounting profit. Sir, if you have claimed depreciation, because of claiming depreciation, sir, expenses would have been increased. The PAT would have been decreased. But why you have claimed the depreciation? You have claimed the depreciation just for the purpose of payment of tax, because depreciation is a charge against the profit. My dear lovable students, sir, after your PAT, that is profit after tax, I will be add back the depreciation if I have claimed the depreciation. If I have not claimed depreciation, there is no concept of depreciation at all. So you will be getting the cash flow. This cash flow is called as cash flow after tax but before depreciation. Cash flow after tax but before depreciation. But we will be shortly called as throughout this chapter, which is CFAT, which is cash flow after tax. So what is the format of the cash flow after tax? Have a quick recall of that. Sir, this chapter is mainly based upon one term, which is CFAT. This chapter is not based upon profit. This chapter is based upon CFAT. So sales will be there. From that sales, you have to reduce the cost of goods sold. You will be getting the GP. From that GP, if depreciation is there, you have to reduce the depreciation. After claiming the depreciation, I will be getting the profit before tax. I have to pay the tax. That's it. For the purpose of payment of tax, I have reduced the depreciation. Then I will add back the whatever depreciation I have reduced. Because depreciation is a non-cash item, automatically I will get the cash flow, my dear lovable students. Being non-cash expenditure, depreciation has been added back while calculating the cash flow. The answer what I am getting is called as, sir, CFAT. My dear lovable students, what are the categories of cash flow? If you are seeing in AS3, I am having cash flow from operating activity, cash flow from financing activity, and cash flow from investing activity. The same way, this chapter, investment decision, I will categorize the cash flow as initial cash flow. That means at the start of the project, there may be so many cash outflows will be there. Generally, this will be cash outflows. There may be some cash inflows also. I'll be net it off to find out the net cash outflow, my dear lovable students. This is the initial cash outflow. Then interim cash outflow in between the project. Sir, it will generate cash inflows. Generally, interim cash inflow will be cash inflow. Interim cash flows will be cash inflows, but there is no need that it should only be cash inflows. Sometimes you may have cash outflows also. I hope that you are able to appreciate or understand. At the end of the project, you'll be having lot of cash flows called as terminal, sir, cash flows. Terminal cash flows such as salvage value will be there. Release of working capital will be there. I hope that when you are hearing all these words, whatever sums you have done is striking your brain. Fantastic to the core, sir. If yes, just pin in the comment section, my dear lovable students. So we are going to talk about initial cash flow. These are the cash flows which will be going out or coming in at the start of the project. Then we'll be talking about interim cash flow, that is between the life of the project, and the terminal cash flow, that is at the end of the project. Fantastic to the core. So we are going to talk about, sir, the initial cash flow. Initial cash flow are further divided into two categories based upon the fresh proposal or the replacement decision. What capital budgeting you are going to do? Are you going to purchase a plant and machinery for the first time? That is called as fresh proposal. No, sir. Already I am having a plant and machinery, sir. I am going to exchange that plant and machinery. I am going to replace that plant and machinery. I am going to sell this plant and machinery with a new plant and machinery. That is called as replacement decision. So in exam, you have to check that whether the question is a fresh investment or a replacement decision. Only two things are there in capital budgeting: fresh investment or a replacement decision. If it is a fresh, sir, if the decision is relating to investment in a fresh proposal or expansion decision, then what is the cost of the new asset? How much rupees I am going to pay to acquire the new asset? This will be my cash outflow, right, sir? Yes, sir. So I have to pay for the plant and machinery. For example, 50 lakh rupees I am paying for the plant and machinery. Add installation or setup cost as per AS 10 PPE, whatever directly attributable expenses you are incurring to bring the asset till the management wishes to use it should be included in the PPE. So this is also cash outflow, my dear lovable students. Add investment in working capital in order to make that plant and machinery workable, my dear lovable students. We have to invest some amount in the working capital, and this working capital may be released at the end of the project. That is called as terminal cash flow. So there at the release we have to add it. Don't forget to add it. So this is the total initial cash outflow, my dear lovable students. Simple. So the cash flow classified into three categories. Number one, initial cash outflow. Then number two is interim cash flows and the terminal cash flows. Right, sir? Now we are determining the initial cash flows. Initial cash flows, you have to check for what project you are looking it into. Whether it is, are you going to invest in a new machinery or replacement decision? If it is a new machinery, very simple, you are going to purchase the machine, which is the cost of the new asset. Add, that has to be installed, that will also be a cash outflow. Add investment in working capital. This is the total cash outflow. I hope that you are able to appreciate your understanding and enjoying. If the decision is relating to a replacement decision, already you are having old asset with you. Now you are going to buy a new asset, right, sir? So when you are buying the new asset, cost of the new asset will be a cash outflow. Comfortable, sir? Yes, sir. Add installation or setup cost, right, sir? Yes, sir. Because the new asset has to be installed in your premises. Sir, add or less, increase or decrease in the net working capital level. Sometimes some working capital may release. If the working capital release means cash inflow. If, my dear lovable students, sometimes because of the new plant and machinery, you are supposed to put more and more working capital into it. If you are putting more and more working capital, then you have to spend money. Then it is a cash outflow. That's what it may be add. It may be less. We don't know. So first, what you are to do, you are supposed to first purchase the new asset. Fantastic to the core. My dear lovable students, for purchasing the new asset, money will go out. That's what cost of the new asset. That asset has to be installed. Add installation or setup cost. Now, sometimes I have to put more working capital, or since I was already using the old machinery, some working capital may be released. That depends upon the situation. If I have to put more working capital, it will be a cash outflow. Then I have to add it to the total cash outflow. If some working capital is releasing, my dear lovable students, then it will be an inflow. So I have to put in bracket. Then less. Net proceeds from the sale of old asset. Automatically, I will be selling that old asset. That will reduce my net cash outflow, right, sir? So I will be having some scrap value, or I would have got some money from the outsider that I have to put in bracket, right, sir? Add or less tax expenses due to sale of the old asset. Sir, because of selling that old asset, surely tax effect will be there. Sometimes I would have earned profit on sale of the old asset, or I may be having loss on sale of the old asset. If I am having profit on sale of the old asset, my dear lovable students, that will be treated as cash outflow. If I am having loss on sale of old asset, that loss on sale of old asset will be debited to the P&L account. It will be treated as a deemed inflow. That's why again, add or less, you will be getting the initial cash outflow. What a clarity, sir. Fantastic, sir. If you are enjoying that, I just want to know from you, my dear lovable students, for taking this much efforts, are you enjoying or not? Just to get that in the comment section, I am shouting here. That too, sir, this much strain I'm taking just for you, my dear lovable students. So, cash flow classified into 3 categories, my dear lovable students. Number 1 is, sir, initial cash outflow. Initial cash outflow means first I am going to spend the money, right, sir? That when you are analyzing the initial cash outflow, you have to check that whether it is for the individual project or whether it is for the new project or for the replacement decision. If it is for the new project, very simple, my dear lovable students, cost of the new asset, you have to purchase it. Add installation or setup cost, that again will be a cash outflow. Then investment in the working capital, you will get the total initial cash outflow, right? Fantastic. If you are already having a asset with you and you are going to replace that asset, first buy the new asset, cost of the new asset, settle it, sir, set up it. So add installation charges. Are you really with me? Then sometimes, sir, change the effect in the working capital. So working capital inflow or outflow will be coming, right, sir? Fantastic to the core, sir. Now sell the old asset. Have you taken care of all the new asset items? Yes. Now sell the old asset. You will be getting some amount, right, sir? Fantastic to the core, sir. And because of selling the old asset, you will be end up with either profit or loss. For that, you will be having tax effect. If you are liable to pay the tax, it will be treated as a cash outflow. Sometimes you will be end up with a loss. It will be a deemed inflow. I believe that you are able to appreciate and understand. Fine. Now, either the new asset come into existence or, my dear lovable students, either the new asset come into existence or sometimes you would have replaced the old asset with a new asset. Now, you started using that asset. So between the life of the asset, you will be having cash flow. That is called as interim cash flow, my dear lovable students. Interim cash flow, in between cash flow. Interim cash flows are further divided into 2 categories on the basis of the fresh proposal or replacement decision. The same way, sir, the capital budgeting itself is classified into 2 categories, whether it is a fresh proposal or the replacement decision. If analysis is related to fresh or completely a new project, you have to take the PAT. What is PAT? Sales minus variable cost, contribution minus fixed cost, EBIT. From the EBIT, I have to pay the interest, right, sir? From the interest, sir, if I am paying that interest, I'll be getting the profit before tax. Pay the tax, you'll be getting the PAT. Sir, this chapter is not taking decision based upon PAT because this you have reduced already sales minus variable cost, you will be getting the contribution minus fixed cost is what EBIT. Inside this fixed cost depreciation will be there. Yes, sir. Inside this fixed cost depreciation will be there. Is this depreciation a cash item or a non-cash item? It is a non-cash item. So you are supposed to add back that depreciation. Yes, sir. Sir, add or less net decrease or increase in the working capital. Sometimes in between the life of the project, in between 5 or 10 years, I have to put some working capital. So that may lead to, sir, cash outflow or cash inflow. I will be getting the interim cash flow for the period, my dear lovable students. So what I have to take? I have to take the PAT, profit after tax. So I have already paid the tax. I have already paid the tax means, my dear lovable students, sir, I would have already claimed the depreciation. Whereas depreciation is the non-cash item. I should add back. So I will be getting the CFAT basically. Before getting the CFAT, sometimes on interim cash flow, I may have to invest the money by way of what? Working capital, or working capital may release in between the project. That also has to be adjusted. Whereas if the analysis is relating to a replacement decision, that means, sir, already one machine was there with me. I have replaced that machine. Now that machine has been working. Then what I have to see is incremental, incremental. What incremental, my dear lovable students? Nothing. What is the net increase or decrease in operating revenue? Simple. If I have used the old machinery, I would have got 1 lakh rupees as cash flow. Because of replacing the machinery, I got 12 lakh rupees as the operating revenue. This 2 lakh rupees extra will only be considered. This 2 lakh rupees extra will only be considered, my dear lovable students. Sir, then add or less net decrease or increase in the operating expenses. Because of the new machinery, what is the increase or decrease in the operating expenses? You will get the net change in the income before tax. What is the incremental income before tax? From that, you will be paying, sir, net increase or decrease in the taxes. So you will be considering only the net income, net change in income after tax. So I will not consider the PAT. I will consider only the incremental PAT. Everywhere you use the word incremental, incremental, incremental. Instead of PAT, you use the word incremental PAT, right? Earlier you have added depreciation, now you don't add depreciation. Now you add the incremental depreciation. That is the difference between the depreciation for the old asset and the depreciation for the new asset. You will be getting the incremental net cash flow for the period. Fantastic to the core. So 2 cash flows we have analyzed, my dear lovable students. The first one is initial cash flow. Check whether the project is a new project or a replacement project. Fantastic. Interim cash flow. You check whether the project is a new project or a replacement project. If it is a new project, simple PAT. From that PAT, you have to add back the depreciation. You have to adjust the working capital changes. You will be getting the interim net cash flow. Whereas if it is a replacement project, my dear lovable students, don't take PAT. You have to take the incremental PAT. Sir, add back incremental depreciation. Then you have to find out the incremental net cash flow. I'm coming to the terminal cash flow, man. I am going to close the project, man. At the end of the life of the project, sir, we will be having final salvage value. That means you have to dispose the asset. You have to dispose the asset, right? Sir, add, that is a final salvage value, disposal cost of the asset. Add interim cash flow. That means even for the 5th year, even though it is for the year number 5, you will be having interim cash flow for the year number 5. So that's what add interim cash flow. Add or less tax savings due to sale or disposal of asset, including depreciation. Because of selling that asset at the end of the project, surely you will be having profit or loss on that. So because of the profit, sometimes I may liable to pay tax to the department. If that is the case, that tax should be treated as a cash outflow. Or, my dear lovable students, I will be getting, my dear lovable students, sir, end up with a loss. That loss will be treated as a deemed inflow and add release of net working capital. At the initial stage of the project, I would have put the working capital that I would have treated as a cash outflow. But at the end of the project, I will be releasing that working capital that will be treated as a cash inflow. I will be getting the terminal cash year net cash flow, my dear lovable students. So if you may have 2 type of project classified into 2 category. Number 1 is the fresh project, or number 2 is the sir replacement project. If it is a fresh project, I have to calculate 3 type of cash flow, right sir? Initial cash outflow, then interim cash flows, and also the terminal cash flows. Are you all really with me? But replacement also I have to classify into 3 category, right sir? Sir, initial cash outflow and interim cash flows, and also the terminal cash flow. The terminal cash flow for the both are one and the same. There is no further classification. Fantastic to the core. Now the statement showing the calculation of the CFAT, such type of question you would have done. Lot of book back questions are there. They won't give the CFAT directly. We have to derive the CFAT, right? How? You have to check what is the total sales number of units. How many units you have sold? From sales, I have to start. What is the selling price per unit? Yes, you will be getting the total sales value, right? In order to make that sales value, I have to incur the variable cost, right, sir? So that's what less variable cost, I will be getting the contribution, which is nothing but sales minus variable cost contribution. From that, I have to reduce the fixed cost. Since this chapter is capital budgeting, fixed cost will be classified into 2 categories. One is cash fixed cost and the depreciation. Cash fixed cost I will not add back, since depreciation is a non-cash item. After the payment of the tax, I will add back to find out the CFAT. Fantastic to the core, sir. I will be getting earnings before tax. Super, sir. From that, I will be paying tax. I will be getting PAT, sir. This chapter, I will not take decision based upon the accounting profit. In this chapter, I will take the decision based upon the cash flows. So to that fact, I will be adding only the depreciation, not all the fixed costs, because inside the fixed cost, I will be having cash fixed cost and non-cash fixed cost. Non-cash fixed cost such as depreciation, only depreciation will be added back, my dear lovable students. I will be getting cash flow after tax. That's what CFAT is all about, cash flow after tax, my dear lovable students. So very simple, man. Sales minus variable cost contribution. Sir, I will be reducing minus cash fixed cost and minus depreciation. I will classify that into 2 categories. I will be getting earnings before interest and tax. From that, if any interest is there, I will pay that. Then I will be getting the earnings before tax. From that, if there is any tax, I will pay that. I will be getting PAT. I will not take decision based upon the PAT. I will just add back the depreciation. I will get the CFAT. Based on that CFAT, I will be start playing my game. What is my game? Is what the next discussion is talking about, the capital budgeting technique. Fine, the biggest slot of the capital budgeting done. Sir, capital budgeting technique. Now I am going to compare the cash outflow with the cash inflow, my dear lovable students. Cash outflow with the cash inflow, which is nothing but the CFAT. I am having traditional or non-discounting methods, or I am having time adjusted or discounting cash flow. What is this traditional or non-discounting payback period? Simple payback period. For example, today I am putting 10 lakh rupees for my project, my dear lovable students, 10 lakh. And year 1, year 2, year 3 and year 4. Sir, this many years are there. In year number 1, I am able to recover 2 lakh. And year number 2, I am able to recover 8 lakh. That's it. 2 lakh plus 8 lakh. The project life is 5 years. But within 2 years itself, I have recovered or recouped my money. That's what. So, the payback period is 2 years. Simple. Sir, ARR, average rate of return. Sir, what AR Rahman is saying that, my dear lovable students, I will be taking decision based upon the accounting profit, because this entire chapter is based upon the cash flow. But AR Rahman will be taking decision based upon the, sir, profit, PAT. I will not add back the depreciation. To the PAT, if I add back the depreciation, I will get the CFAT. All other technique, I will be taking decision based upon the CFAT. But AR Rahman alone will be taking decision based upon the PAT. Are you all really with me? Then, if you are considering the time value of money, discounting factor, which is net present value, PI, IRR, MIRR, and discounted payback period, shall we start discussing one by one? Are you ready for the discussion, my dear lovable students? The first one is payback period. Wow. So you are going to invest in a project. Within how much time my money will come back is what payback period. So payback period of an investment is the length of the time required for cumulative total net cash flows from the investment to equal the total initial cash outlay. For example, 10 lakh rupees if I am spending in a project, in order to get back that money, how much time I should take is what the payback period. So payback period is equal to total initial capital investment. Total initial capital investment, for example, if I am putting 10 lakh rupees and divided by annual expected after tax net cash flow. For example, every year if I will be getting, my dear lovable students, 2 lakh, sir, I need 5 years to recoup the money. Sir, if I will be getting 5 lakh, then I need only 2 years to recoup the money. That is called as, sir, payback period. Always the people will choose the project with the lower payback period, because that is safety for them. How quick we can get the money back is what the payback period. Enjoying, my dear lovable students. Next one is ARR. That is AR Rahman. I will generally call in class. What AR Rahman is saying that, sir, you have to take the profit after depreciation divided by investment in the beginning of the year, or average annual profit divided by investment in the beginning. Sir, what is, sir, average investment? Average investment means half of initial investment minus salvage value plus salvage value, which is nothing but, man, ARR is equal to average annual profit. That means year 1 you will be having profit, year 2 you will be having profit, year 3 you will be having profit, year 4 you will be having profit, and year 5 you will be having profit, right? If you add all the profit divided by 5, you will be getting the average PAT divided by. Sir, numerator you are taking average, so denominator should be what? Average. That's why divided by average investment into 100. So average by average. Then it will be monkey by monkey. Otherwise it will be monkey by donkey, right? Sir, what do you mean by average investment? You tell me, sir. Initial investment, for example, if 10 lakh rupees I put in a project, at the end of the period I will be having salvage value. So salvage value is there in the start and also at the end. So remove that, my dear lovable students. The balance will be there opening and it will not be there in the closing. So take that amount as the average plus, sir, the salvage value, because salvage value will come at the end of the project. That's why it is called as average investment. Fantastic to the core. So these are the very simple two non-discounting technique. What are the two non-discounting technique? Payback period. What is payback period? Within what time we will be get back the money, which is nothing but how much money you are going to put today. Every year, how much you are going to get back. That is what is ARR. ARR is based upon PAT, not based upon CFAT. So which is nothing but average PAT divided by, my dear lovable students, average investment. Average investment is nothing but take the opening investment, initial investment, minus the closing, only salvage value will be there. So the remaining money only will be there throughout the project. Take the half of it plus salvage value, which you will be getting at the end. That's it. Coming to the net present value, that is a discounting technique. Net present value. Today, if you are investing in a project, for example, today is the Y0, correct? If you are investing, sir, 5 lakh rupees today, you will be getting inflow in Y1, Y2, Y3, Y4 and what? Y5. So your cash flow after tax maybe 1 lakh, 2 lakh, 3 lakh, 4 lakh and what? 5 lakh. If you are simply adding this, surely your cash inflow will be more than the cash outflow. But the timing of the checking is both are different, because cash outflow is today and cash inflow is in future. How I'll be compare today with future? I can compare either today with today or future with future, comfortable. So what I have to do is I have to bring the future value into the present value, my dear lovable students. I have to bring the future value into present value. So two things are there. One is called as, sir, present value, other is called as future value. From present value you have to move into future value. You have to do a process called as compounding. Sir, from future value, if you want to come back to the present value, you have to do a process called as discounting. For this discounting, we will be using present value factor. That present value factor is nothing but KO, which is nothing but cost of capital. For that only we are studying the chapter cost of capital. Wow, fantastic to the core. For example, if the company's KO is 10%, my dear lovable students, in calculator we used to put that 1 divided by 1.1. That will show that, sir, 0.909, that everyone knows. What this means, sir, after 1 year, if I am getting 1 rupee, it is equal to, sir, 90 paise today. So 1 rupee after 1 year is equal to 90 paise today, right, sir? So all this money I'm going to get at the end of the first year, second year, third year, fourth year and fifth year. So these all are in future value. So we have to bring all that money into today's value. That is called as, my dear lovable students, sir, I am discounting the future cash flows to bring that into the present cash flow. Then what I will be getting after discounting? We will be getting the discounted cash inflow. Discounted cash inflow. You tell me, is this discounted cash inflow is on today or in future? It was in future, but we converted into today. So to this discounted cash inflow, we have to reduce the discounted cash what? Outflow, my dear lovable students. Then you will be getting the net present value. Why net present value? Because this is also in the present value. Sir, this is also in the present value. Actually, inflow was in future value, but by using a technique called as discounting, we have converted that into the present value. So inflow is also in the present value and outflow is also in the present value. That's why you are getting the net present value. I believe that you are able to appreciate or understand that. So if in the project, my dear lovable students, if NPV is, sir, positive, you will accept the project. That's what NPV. The NPV technique is a discounted cash flow method that consider the time value of money in evaluating the capital investment. So this is the decision rule with regard to NPV, my dear lovable students. What the NPV? If the NPV is either equal to or more than 0, then accept the project. If NPV is less than 0, then reject the project. That's it. So if you are getting a positive NPV, accept the project. If you are getting a negative NPV, reject the project. That's it, my dear lovable students. So this is one way of analyzing things, which is nothing but, sir, discounted cash inflow minus discounted cash outflow. If my discounted cash inflow is more, that means I'm going to earn more. Automatically that extra money, what you are calling it as NPV. All time NPV we will be expressing in amount only. Sir, you want to know that today you are putting 1 rupee. In future, will you earn 1 rupee? For that, every 1 rupee, how much you will be earning? Whether it is 1.2 rupees or 1.5 rupees. My dear lovable students, that is called as discounted cash inflow divided by discounted cash outflow. That means, sir, for every 1 rupee you have invested today, I am going to get 1.2 rupees in future. That means that is called as profitability index. Profitability index. So generally in my class, I used to say that if you are minusing, you will be getting NPV, and if you are dividing, you will be getting the PI, profitability index. Fantastic to the core. So PI, in comparing alternative proposal of comparing, my dear lovable students, we have to compare a number of proposal, each involving different amount of cash inflows. So if you are having multiple projects to choose, out of that, you just want to choose only one of the project because the project may be mutually exclusive. At that time, this technique will be very useful. In project number 1, if I put 1 rupee, I'll be getting 1.5 rupees. Sir, in project number 2, I will be getting only 1.2 rupees. But in project number 3, I'll be getting 1.8 rupees. So it is very easy to choose which project has to be chosen, my dear lovable students. One of the method for comparing such proposal is work out what is known as the desirability factor or the profitability index or the present value index method. In these names and all, we may get in examination. So PI is equal to discounted cash inflow divided by discounted cash outflow. What is the thumb rule, my dear lovable students. If the PA is more than 1, accept the project. If the PA is less than 1, reject the project. That's it. Sir, if the NPV is positive, accept the project. NPV is negative, reject the project. And if the profitability index is more than 1, my dear lovable students, accept the project. And profitability index is less than 1, then reject the project. Fine. Now, I have just played with the discounted cash inflow and discounted cash outflow. I'm coming to the next, sir, game. Very simple, sir. What was the game? Very simple game. Sir, I was having future cash flows, right? But I am having the cash outflow. This has happened at present, but this has happened at future. So I have discounted this by using present value factor at the rate of 10% or 12% or 15%, which is nothing but the cost of capital of the company. So I have converted the future cash inflows into the, sir, discounted cash inflow minus discounted cash outflow. Then I will be getting NPV, net present value. Sir, if I am dividing, that is discounted cash inflow divided by discounted cash outflow is equal to, my dear lovable students, I will be getting PI. It shows that for every 1 rupee invested, what will be the return, my dear lovable students. Then I'm coming to the last discussion, which is nothing but the IRR. Sir, there is a rate. I don't know what is that rate. That is a magical rate. At IRR, my discounted cash inflow will be equal to discounted cash outflow. Are you all really with me? Which is nothing but, sir, today I am going to spend. I know that, sir, today's reality, I know. Discounted cash outflow, for example, today I am going to spend 10 lakh. But in future, I am going to get the cash inflow as year number 1, year number 2, year number 3, year number 4, and year number 5. So, my dear lovable students, in that year, I will be having the cash inflows. But these all are in future value. I have to discount at some rate. It may be 10%, 12%, or what percentage? I don't know. If I discount that at some percentage, my discounted cash outflow of 10 lakh will be exactly equal to the discounted cash inflow. That rate is called as IRR, which is called as internal rate of return. So IRR for an investment proposal is a discount rate that equates, that's equal, that will make equal the present value of the expected net cash inflow with the initial cash outflow. So which is nothing but, man, if you are doing minus, that is, sir, discounted cash inflow minus discounted cash outflow is equal to, you will be getting NPV. If you are dividing, sir, discounted cash inflow divided by discounted cash outflow, you will be getting PI. Fantastic to the core. If you are putting equal to discounted cash inflow equal to discounted cash outflow is equal to IRR. Okay, fine. All the 3 techniques we are playing with only 2 terms. Fine. Sir, when I am revising all this, you would have done a lot of question. All the question will be coming to your brain. That revision is what I need at this last moment of the time. So IRR for an investment proposed is the discount rate that equates the present value of the expected cash flow with the initial cash outflow. So we have to calculate the IRR by using the interpolation method. Sir, we know how to do the interpolation method. That is purely mathematical. So what is the acceptance rules? If the IRR is more than the WACC, we know the KO. If the KO is 10% and the IRR of the project is 12%, that means, sir, the project will give me a return of 12%. With that, I will be have to meet the cost of only 10%. What the project? Accept the project. Whereas if the IRR is less than the cutoff rate, that is WACC, so the project will give me only a return of 10%, but the KO is 12%, then reject the project, man, because by doing that project, I will not be able to satisfy my investor. I will not be able to satisfy the liability side of the balance sheet. So don't do that project. That's the cutoff with regard to the IRR. Sir, what is the summary for this entire chapter for our examination? Very quick, sir. These are the decision making. When you are doing decision making question, keep this in mind. You have to check that, are you going to do for independent project or mutually exclusive project? Sir, you'll be having non-discounted technique like payback. Payback means, sir, for an independent project, sir, maximum acceptable payback, when the payback period is less than or equal to the maximum acceptable payback period, then accept it. When the payback period is more than maximum acceptable payback, then reject it. For example, if you are going to evaluate a project, okay, the life of the project is 5 years. The payback itself is showing, sir, 6 years, then don't accept the project. If the payback is showing less than, if you are keeping a 3-year time limit, if it is showing within 2 years, accept the project, man. Sir, with regard to ARR, when the ARR is more than minimum acceptable rate of return, accepted. You will be having a minimum expected return. You are expecting 10% return, but that project is giving 12% return. Oh, fine, accept it. If it is less than the minimum acceptable rate, reject the project. This is what if the project is an independent project. With regard to NPV, if the NPV is more than or equal to 0, accept it. Less than 0, that means we will end up with a loss. So better not, no need to do the project, reject the project. With regard to PI, if it is more than 1 rupees, my dear lovable students, then accept the project, because if I invest today 1 rupees, I should get more than 1 rupees, right? If I am getting less than 1 rupees, reject the project. Better no need to do that project, right? IRR, if it is more than WACC, that is KO, accept the project. If the IRR of a particular project is less than KO, why are you going and dying, man? Reject the project. But if the project are mutually exclusive, that means if you choose one project, you can't choose the other project. That's what mutually exclusive is all about. With regard to non-discounted, my dear lovable students, project with least payback period should be selected. That means if two projects are there, one project's payback period is 3 years and other project is 5 years, you have to choose project A. The project with the least payback period should be selected. With regard to the mutually exclusive ARR, my dear lovable students, then project with the maximum ARR should be selected, because ARR means average rate of return. A project which is giving the maximum return should be selected, right? If one project is giving 10% ARR and another is 15% ARR, I will select the project which is having highest IRR. And with regard to NPV, my dear lovable students, project with the highest NPV should be selected, because NPV shows the discounted cash inflow minus discounted cash outflow. That means in which project I'm having the more cash flows, that project has to be selected. Profitability index, my dear lovable students, when the NPV value is same, NPV is same, project with the highest PI should be selected. Sir, because if I'm investing in first project, for every 1 rupee, I'll be getting 1.2 rupees. But in the second project, for every 1 rupee, I'll be getting 1.5 rupees. So better to get 1.5 rupees than 1.2 rupees, right, sir? So better to choose 5 rupees project. So project with highest PI should be selected. And IRR, project with the maximum IRR should be selected, because all these are in positive notes. So always a project with a positive note should be selected, my dear lovable students. This is the quick recap of our chapter, that is capital budgeting. Sir, in that, sir, you have to first determine the cash flow, which is initial cash flow, interim cash flow, and also the terminal cash flow. And after that, you have to find out the CFAT, how to determine the CFAT, and we have to quickly apply the techniques, that is payback period. Sir, the project with the lowest payback period should be selected, highest IRR should be selected, highest NPV should be selected, highest PI should be selected, highest IRR should be selected, and the lowest discounted payback period should be selected, my dear lovable students. I believe that, sir, this revision, quick revision, because before the day of examination, we can't spend so much of time in one topic. It's not a regular class. I have to quickly brush up what and all is there in the chapter. I believe that this quick revision is useful for you. Only for you I have done this, my dear lovable students. If yes, I just want one of your happiness as comments. Sir, I'm wishing you all the very best for the coming examination. We have done with the leverage analysis, ratio analysis, cost of capital, capital structure theories, dividend decision, and also the capital budgeting. The only pending in our list is working capital management. After this, quickly take a 5 to 7 sums and quickly go through the 5 to 7 sums, and we will be having time constraint. Do 1 or 2 sums just to get the practice and quickly come back to me. I will be revising the pending topic also. Sir, I wish that, sir, everyone should get a super exemption in FM and SM, and I wish you all to see you as a CA final student. We'll meet at the appropriate time. Thank you. Bye-bye from me. My dear lovable students, in this chapter, working capital management, from the exam perspective, we'll be getting estimation of working capital. Estimation of working capital. It is very easy, man. First, understand what is working capital. Working capital is equal to current asset minus current liabilities. So, we are going to deal with the balance sheet item. In balance sheet, we all know that, my dear lovable students, we will be having fixed asset and we will be having current asset. And here we will be having current liability. Sir, if we are dealing only with the current assets and current liability, current asset minus current liability is called as working capital management. So, as a financial person, you have to manage the fixed asset. The management of fixed asset is called as capital budgeting, and management of current asset as reduced by the current liability is called as working capital management. So we are going to talk about working capital management. So join along with me. What is working capital? Which is nothing but current asset minus current liabilities. So management of working capital is about the management of the current assets and the current liability. So if how you are going to manage your current asset, how you are going to manage your current liability in a business, that's what basically the working capital. That is, sir, in a broad classification, current asset that meet management attention, such as datas. We have to take care of datas, whether we are getting the datas properly or not, whether we are able to recover the money from the datas or not, And the next one is inventory, and the cash and advances like prepaid expenses, whether the prepaid expenses is perfectly paid, whether we are able to adjust it or not. All those management is called as working capital management. In the liability side, current liabilities are like payable creditors and other outstanding dues. Fine, fantastic to the core. So why I have to manage the current assets and current liability? Because it will affect the liquidity. Someone is quickly coming and asking, creditor is coming and knocking the door and asking that, give me money, where I will go for the money. So I have to always keep the liquidity. And number two, it will affect the profitability, because if I am carrying lot of stock, lot of data which are unrealizable, then automatically my profitability will get affected. That's why this chapter is teaching us, saying that, my dear lovable students, it will affect both the liquidity and the profitability. So you have to be very, very careful with your current assets and current liabilities, right? So my dear lovable students, sir, we are going to talk about the various approaches of the working capital investment. So as a businessman, if I am starting a business with, for example, 100 crore, entire 100 crore I can't invest in plant and machinery. If with this entire 100 crore, if I buy a plant and machinery, with what I will make the production? So there should be some fund should be allocated to the day-to-day activities of a concern or a business. Such activity, such allocation is called as working capital management. My dear lovable students, that allocation may be aggressive or conservative or moderate. So three ways in which I can allocate the capital. One is called as aggressive, other is called as conservative, and other is called as moderate. What is aggressive? Investment in working capital, current asset, is kept as minimum. For example, I will not keep so much of current asset. I will be keeping only less amount of current asset. That means I will be so much aggressive in my working capital policy. That is, entity hold lower level of inventory, follow strict credit policy, keep less cash balance. That is called as so much aggressive. Sir, generally we will have an understanding of a reverse opinion, right? Aggressive in the sense means keeping lot. No. We will be keeping only less amount with the current asset, less stock we will be holding. Once we make the credit sales, we will ask to quickly get the money. That is called as, my dear lovable students, aggressive policy. Number two is conservative policy. Investment in working capital is increased. That is, current asset is increased as compared to the aggressive policy. That is, entity maintain higher level of inventory, follow liberal credit policy, and keeps cash balance as high as to settle any current liability immediately. So if I am having less amount of current asset, that is called as aggressive. Sir, if I am having good amount of current assets, that is called as conservative, my dear lovable students. Sir, what is moderate? Under this approach, a balance between, sir, I will be keeping a balance between the risk and the return is maintained to gain more by using the fund in a very effective manner. So these are the three ways in which you can maintain the working capital. So I can have aggressive, or I can have average, or I can have conservative, my dear lovable students. So up to this much will be the fixed asset level. So I can have aggressive. Aggressive means not much I will be keeping. I will be keeping only less. Average means I will be keeping, sir, medium, and conservative means I will be having sufficient amount of current asset. So if you are keeping less current asset, aggressive, more current asset, conservative, in between, that is called as moderate. That's what the ways in which you can keep the current asset, my dear lovable students. Surely I have to estimate the working capital for every business, sir. Everyone should know. For example, if you are going for a tour, you should know how much is the daily expenses you are going to incur. In the same way, in a business, my dear lovable students, estimation of what capital, working capital, you have to estimate the working capital. Sir, what are the methods of estimating working capital? By way of operating cycle. By way of operating cycle means it is a working capital cycle, indicate the length of time between the paying for material entering into the stock to realization from the sales to the finished goods. Because, sir, first the raw material will be supplied by the creditors, correct? Then that raw material has to be converted into WIP. Then that WIP has to be converted into finished goods. Then that finished goods has to be converted into debtors. Then that debtors has to be converted into cash. And this cash has to be paid back to the creditor who supplied the raw material. This is called as one cycle. So how much time I am taking in my business to convert the raw material into cash is what my working capital cycle. Comfortable, sir? So first there will be cash with me. Then raw material, labor, overhead, which we have already studied in the costing, which is direct material plus direct labor plus direct expenses will give the prime cost. By incurring all that, I will make the production, my dear lovable students. Then that, sir, will be converted into WIP. That WIP will be converted into finished goods. That finished goods has to be converted into debtors. and I have to collect money from the debtors, that is called as cash. This is called as operating cycle. This is called as operating cycle. So operating cycle is equal to, in the form of equation like this, we can express the operating cycle, which is nothing but raw material storage period. Tell me, raw material storage period. That means after I purchase a raw material, how much time the raw material is with me is what raw material storage period. Now the raw material will be there in the stores, as we already discussed in the cost sheet, my dear lovable students, that there will be three places inside the organization. One is called as factory. Inside factory will be having stores. Inside the stores only we will keep the raw material, right? And that raw material will be sent to the factory for the purpose of production. So raw material storage period and WIP holding period plus finished goods storage period. So this basically represent the factory, my dear lovable students. So inside the factory we are having stores ledger control account, WIP ledger control account, finished goods ledger control account. This is what the holding period. How many days you are keeping the raw material? How many days you are taking to convert the raw material into WIP? How many days you are keeping the finished goods inside the factory? And this has to be converted into debtors. That's what receivable or debtors collection period. Minus, my dear lovable students, creditors, credit period allowed by the supplier is the one working capital. So just think, sir, very easy, sir. First, raw material will be there. Raw material storage period plus WIP holding period plus finished goods storage period, sir, plus debtors collection period minus creditors payment period is equal to working capital cycle. Are you all really with me what I am talking to you? Now, how I have to calculate the raw material storage period? Very easy. What is the average stock of raw material divided by average cost of raw material consumption per day? How will be calculating? Sir, average stock of raw material. Just think, man. Average stock of raw material. Just let me ask you one question to you. For example, if you are having 10,000 rupees in your hand, now in your pocket 10,000 rupees are there, and daily you need 1,000 rupees for your expenses. You tell me for how many days you are having cash in hand? 10 days, correct? The same way only, material storage period means what is the average stock of raw material? How much average stock I am having per day? What is the average cost of raw material consumption per day? This is what number one. Number two, WIP holding period. So I am going to calculate the WIP. No, sir, average cash balance, how much you are having? Total cash in hand divided by expenses per day. This example you keep in mind. Then the average WIP, my dear lovable students, divided by average cost of production per day. Easy. Sir, finished goods storage period is nothing but, sir, average stock of what goods? Finished goods divided by average cost of goods sold per day. Easy, sir. Sir, receivable debtors collection period is equal to average receivable divided by average credit sales per day. Getting it, sir? And credit period allowed by the creditors is equal to average payable divided by average credit purchases per day. So, very quick, sir, my dear lovable students, the concept is nothing but this. I am looking into the storage period. How many days I am holding the raw material, which is nothing but what is the average stock of raw material I am having. What is average stock of raw material? Opening stock of raw material plus closing stock of raw material divided by 2. Very simple. In the cost sheet itself, we have studied. I taught you in the cost sheet that, sir, opening stock of raw material plus purchases of raw material minus closing stock of raw material is what raw material consumed, right, sir? Minus closing stock of raw material, you will be getting the raw material consumed, right, sir? This is a raw material consumed total for a particular year. So I want the raw material consumed per day means nothing but raw material consumed divided by 365. So you will be getting what is the raw material consumed per day. Fantastic to the core. I'll be adding opening stock of raw material plus closing stock of raw material divided by 2 average stock of raw material. So this much average stock of raw material I'm having, and this is the consumption per day. Very simple. Sir, one example for working capital cycle, 10 rupees I am with me, 10,000 rupees I am with me. Every day I am going to spend 1,000 rupees means I am going to hold that for 10 days. The same way. Average stock of raw material divided by average consumption per day. Tell me for WIP, average WIP inventory divided by average cost per day. Then tell me for finished goods, man, average stock of finished goods divided by average COGS per day. Tell me for, sir, debtors collection period, average receivable divided by average credit sales per day. Tell me for creditors, average payable divided by, my dear lovable students, average credit purchases per day. Sir, simple, my dear lovable students, estimation of amount of different components of current assets and current liabilities. we are going into the estimation of working capital. This is a very important topic for today's examination. Estimation of working capital. What is working capital, my dear lovable students? Which is nothing but current asset minus current liability. What and all comprises of current asset? These are the items comprises of current asset. Number one is inventory, my dear lovable students. Current assets means what? Raw material will be there, right sir? Inventory, raw material will be there. This raw material has to be converted into what? WIP. This WIP will become what? Finished goods. This finished goods will become what? Debtors. And receivable, trade debtors. Sometimes this receivable may comprises of debtors will be there, my dear lovable students. Sometimes they may give the bills receivable, right sir? And minimum what balance? Cash balance. This is called as gross working capital. Very simple items of the current asset. Tell me, raw material will be there. It will become WIP. It will become finished goods. That's it. Finished goods will become debtors. Debtors may give us bills receivable. And we have to hold minimum cash balance. How to estimate each and every item one by one by one? No, nothing. Sir, raw material inventory. You tell me, in your home, you have to keep the rice. Rice is the, sir, we have to manufacture what man? Food. Food means what? We have to cook the rice. Sir, it's based upon how much rice you will carry in your home. It's based upon your consumption. If you are going to consume daily 2 kg, based upon that only you'll be keeping the rice. So estimated production unit. My dear lovable students, how many units you are going to produce? So how many finished goods you are going to produce? Based on that only raw material consumption will be there. So estimated production unit divided by either 12 months or 365 days. Then you will be getting how much is the, sir, per month production. For example, annual production is equal to 12,000, my dear lovable students. Divided by 12 means every month you are going to manufacture 1,000 units of finished goods. Comfortable? Into what is the purchase price per day? That's what estimated cost per unit. What is the purchase cost per day? Into average raw material storage period. For how much month you wish to, sir, hold the raw material? You want to keep for 2 months consumption? Then, my dear lovable students, you can keep for 2 months. That's it. Fantastic, my dear lovable students. So, what is the formula? Think of it. How much raw material I have to keep it as stock is based upon how much I am going to produce. Because based upon my, in order to manufacture my finished goods only, I need the raw material. So, estimated production of what? Finished goods. Either it has to be expressed divided by 12 months or 365 days into estimated cost per unit into average raw material storage period. Now coming to WIP, man. Again, the WIP is based upon the finished product. So estimated production or units divided by either 12 months or 365 days. That means you will get how much number of units you are going to produce into estimated WIP cost per unit. What is WIP cost per unit, my dear? This will comprise of material, labor and overhead. We already discussed in the process costing that material will be generally 100%, labor will be 50 and overhead may be 50, or it depends upon the percentage of completion. Are you all really with me? So estimated WIP cost per unit into average WIP holding period. For how many years or how many months WIP you want to hold it as stock. So very simple. So what is the formula for the raw material? Estimated production divided by 12 months or 365 into estimated cost per unit into average material cost. Fantastic to the core. Their estimated production divided by 12 months or 365 into estimated WIP cost per unit into average WIP holding period. Coming to the finished goods, my dear lovable students, estimated production divided by 12 months or 365, you will be getting the number of units into estimated cost of production per unit. Estimated cost of production is, my dear lovable students, which is nothing but material, labor and overhead. Everything would have been completed at how much percentage? 100% degree of completion will be there into average storage period. For how much months finished goods you want to store? You want to store for 2 months, so into 2. You want to, sir, hold it for 5 months, into 5. That's it. Fantastic to the core. Coming to the debtors, man, next element. So we have estimated the raw material, WIP and also the finished goods. When you are estimating the raw material, the relevant cost is only purchase cost. When you are estimating the WIP, the relevant cost is material, labor, overhead, but 100% completion would not have happened. We have to think the process costing. That's it. When you are estimating the receivable, my dear lovable students, when you are estimating the finished goods, sir, you have to think the cost sheet. Generally, the finished goods will be valued at the cost of production. Are you all really with me? Fantastic to the core. Coming to the receivable, man, estimated credit sales. This is not production. This is not production because production is related with the stock, raw material, WIP and finished goods. But here it is estimated credit sales, my dear lovable students. How many units you have sold, you are going to sell it as credit sales. Divided by either 12 months or 365 months into cost of sales, excluding depreciation. Because depreciation is not a cash item, it's a non-cash item. In that cost of sales, linked with the cost sheet, my dear lovable students, sir, you will be having fixed costs. Because add, we know that direct material plus direct labor plus direct expenses will give the prime cost, correct? Add factory overhead. Inside this factory overhead, we will be having depreciation. Depreciation is a non-cash item, my dear lovable students. That should not be included when you are valuing the data. Fantastic to the core. So into average collection period, we already studied that how to find out the average collection period, which is nothing but the average data divided by, sir, what is the credit sales per day? You will get the average collection period. Super, sir. Cash and cash equivalent, generally, which is given in the question, minimum decide cash and bank balance to be maintained. Trade payable, creditors, sir, you tell me, debtors is related with the credit sales. So the creditors is related with the estimated what purchases, credit purchases, divided either by the 12 months. This is annual credit purchases divided by the 12 months will give you the monthly credit purchases, or divided by 365 per day into credit period allowed by the supplier. In credit period allowed by the supplier. Why? Because this we are not going to make anything, my dear lovable students. We are not going to manufacture. Debtors means we have to manufacture and we have to give it to the debtors. So we have to take the cost of sales excluding depreciation, but we are just going to purchase from the creditors. So into credit period allowed by the supplier. With regard to direct wages, very simple, estimated labor hours. How much number of hours that they are going to manufacture into wage rate per hour, my dear lovable students, divided by 12 months or 365 days. So we will be getting what is the monthly labor cost into average time lag in the payment of wages, whether we are going to pay in delay of half a month or 1 month. I hope that, I believe that whenever I am saying whatever questions you have solved is striking your head. Then with regard to overhead, the same, estimated overhead for the entire year divided by either 12 months or 365 into average time lag in payment of overhead. So number of days in year may be taken as 365 or 360 as per the given in the question. So if you are estimating everything, you will be getting raw material. Raw material is nothing but annual production divided by 12 months into what is the purchase price into how much period of raw material you want to keep it as stock. Fantastic. WIP is nothing but average finished goods divided by 12 months or 360 or 365 as the case may be into WIP cost per unit into how much period WIP unit you want to hold. It's fantastic to the core. Sir, finished goods is nothing but annual production divided by 12 or 365 or 360 into what is the finished goods cost per unit into what is the finished goods holding period. With regard to receivable debtor, you have to think that total credit sales for the year divided by 365 or 12 or 360 into, my dear lovable students, sir, what is the cost of sales per unit excluding depreciation. If you are following cash cost approach, if you are following total approach, you have to include the depreciation also. Fantastic to the core. Minimum cash balance will be given in the question. Trade payable is connected with the credit purchases, man. Bills payable, just they will be given in the question. Wages payable is estimated labor hours into rate per hour. You will be getting the total divided by 12 or 365 or 360, my dear lovable students, into, my dear lovable students, what is the time lag. You have to multiply with the time lag. Fine. Payment for overhead, and always will be adding some safety margin, which will be given in the question, either 10% or 15%. You will be getting net working capital. One of the 5-mark estimated question is estimation of working capital. Go and crack the estimation of working capital. I believe that you are able to quickly recall the estimation of working capital in a better way, my dear lovable students. The next one is cash management. How to manage the cash. Cash management, next, the very important component is one of the important component of the current asset is cash management. We'll be having for management of cash, we may end up with cash surplus or we may end up with cash deficit. So we have to go and take the bank overdraft, right, sir? So consideration in need for the cash is what is a transaction need, how much we need for cash, then speculative need and precautionary need. So when you are fixing a cash in hand, these 3 things you should keep in mind. Number 1 is how much is transaction need, speculation need, and also precautionary need. What are the cash flow budgeting? Receipts and payments method. You can follow either receipts and payments method. Receipts and payments method means expected receipts and payments are considered. Cash inflow or outflow of all functional budget, including capital budget, are all considered. Whatever the total cash inflow, total cash outflow, that is working capital receipt I will consider. Capital budgeting receipt I will consider. Everything I will consider. This is called as receipts and payments method. Adjusted income method means annual cash flow are adjusted by adjusting the sales revenue, and cost figures for delay in receipts and payments, that is changes in debtors, creditor, and eliminating non-cash items and all. Depreciation and all, why I have to consider for cash budget? So I will be taking only the relevant cash flows, that is called as adjusted income method. And adjusted balance sheet method means items of balance sheet that are predicted by expressing each type of asset except cash and bank balance. All the other item I will be, sir, predicting like raw material, WIP, finished goods, debt asset, credit asset, and I will keep the cash and bank balance as the balancing figure, and I will feel that that's what the adjusted balance method. Sir, we are having two models, man. William J. Baumol's economic order quantity model. We all know that EOQ. EOQ is equal to root of 2AB divided by C. The same formula here also, root of 2 UPS, which is nothing but C stands for optimum cash balance. How much cash balance we have to keep? That is the optimum cash balance, man. U. Sir, A means annual cash disbursement. How much is the annual there? We will call it as annual demand. Sir, fixed cost per transaction. In order to do every transaction, what is the fixed cost? And opportunity cost per annum per rupee, which is nothing but what we have studied in EOQ, root of 2AB divided by C. There 2 stands for annual requirement. Here A stands for, which is nothing but, man, annual cash disbursement. B stands for fixed cost per transaction. C stands for opportunity cost per unit per annum. This is what Baumol. Sir, here we have to see the economic way. At that economic way, we can keep the optimum cash balance as per this. Fine, man. Miller or cash model, sir, you can have either the 3 limits are there, either upper control limit, return point, or lower control limit. These are the 2 models, man. I'm quickly moving into the very important next topic, which is called as receivable management. Today, an expected question for examination, management of receivable management. That is, how much should be the credit policy I should be giving is what the question, my dear. So what you have to find out is, you have to take the expected profit. Listen very carefully, very important area. For example, first you have to take the credit sales, because for debtor, I am going to fix whether it is 30 days or 40 days or 50 days. Very important topic. Take the credit days. So already present policy would have been given in the question. They will say that proposed policy 1, proposed policy 2, and proposed policy number 3. Right. Total cash other than bad debts and what? Cash discount. Total cost other than bad debts and the cash discount. You have to reduce one by one. Right, sir? One is variable cost. Surely, in order to make the credit sales, I have to make the production. So, production cost is a variable cost I have to take. And fixed cost is also a cost associated. Are you all really with me? These are the direct costs related to the credit sale. Direct costs related to the credit sale. So, take the credit sale. In order to make the credit sale, I have to incur the variable cost and fixed cost, minus it. Fantastic to the core. So, what I will be getting? Sales minus variable cost, contribution minus fixed cost, profit. Just marginal costing technique. The variable cost is nothing but cost of production, and fixed cost is nothing but fixed cost. So, from the credit sales, reduce the variable cost and the fixed cost, you will be getting the profit. From the profit, now reduce the expenses relating to debtor. Exclusive expenses like bad debt. Then number 2 is what? Cash discount. So, you will be getting expected net profit before tax. From that net profit before tax, pay the tax, you will be getting expected profit after tax. Now, you have to reduce, sir, opportunity cost of investment receivable locked up in the collection period. Sir, if I am investing in debtor, my money is what? Blocked in the debtor. So, I am having some opportunity cost. So, that cost also has to be reduced. You will get the net benefit. And in that, which is having more net benefit, you have to choose it. So, what we are going to do in examination, we are going to take the credit sales. From that, direct expense such as variable cost and fixed cost, we are going to reduce it. We will be getting the net profit. From that, directly related debtors cost like bad debts, cash discount, we are going to reduce it. We will be getting the expected net profit before tax. After paying the tax, we will be getting the PAT. Then we are going to reduce the opportunity cost. Why, sir? After payment of tax, you are reducing the opportunity cost, because opportunity cost will not be debited to the P&L account. It is a notional expenses which we are considering only for the purpose of decision making, not for the purpose of tax. That's why after payment of tax, reducing the opportunity cost. I hope that you are able to appreciate or understand. The same thing can be evaluated through incremental approach also. Sir, what is incremental approach? I will be checking that. Sir, this is the present policy. No, more than this, what is the additional sale I am having in the proposed policy 1? Sir, as compared to proposed policy 1, what is the incremental in proposed policy number 2? So, this is what incremental. Comparing with the present with the policy 1, present with the policy 2, present with the policy 3. So, incremental credit sales. Everywhere you add one word called as incremental credit sale. Less incremental cost of credit sale. Sir, that is variable cost and fixed cost. You will be getting the incremental bad debt loss, incremental cash discount, incremental expected profit, less tax. You will be getting incremental expected profit after tax. Are you all really with me? Then you have to compare the cost of sales will be there, variable cost, collection period will be there, investment in receivable will be there, either 360 or 365 days, incremental investment in receivable. Then you have to find out the required rate of return, required rate of incremental investment. You will be getting the incremental net benefit. That means instead of analyzing one by one separately, you have to see what is better, which one is, why first one is better than the present one. Like that, improvement or the increase will be taking. This is called as sir, incremental and financing also receivable. This is pledging and factoring and all theory, my dear lovable students. This, sir, no need to taken care of it. Now, the last sir, area, important area from this is statement showing the evaluation of the fact proposal. For example, I am making credit sales. Sir, I am very bad at collection from the data. So what I am doing is I am just giving the things to a person called as factor. Can I give it or not is the question. So what I have to check, if I am collecting the money from the debtors, I am incurring a cost. But if I am giving to that to an agency, that is called as factor, whether I will be having net benefit or not. That's it. So annual saving, benefit or taking factoring service. What are the annual savings? Number one, cost of credit administration saved. If I am giving to an agent, I don't want to scratch my head, right? So that cost can be saved. The bad debts avoided, because entire bad debt will be taken care by that agency. If 100 rupees I'm selling, I'll be getting 100 rupees. So that is a benefit for me, savings for me. Interest saved due to reduction in the average collection period. If I am collecting, my dear lovable students, I'll be getting money from debtors only 90 days. But if I am giving to agency, the very next day I'm getting the money. 30 days I'm getting the money. So interest can be saved. These are the three savings. What are three savings, man? Administration money can be saved, bad debt can be saved, interest can be saved. These are my benefit, total benefit I have earned. But sir, that NSR factor is not my mamu. I have to pay some amount to that guy, right, sir? So I have to incur factoring commission, my dear lovable students. That is an expense to me. And number two is interest charged by the factor on advance. Sir, actually, that factor will be getting that money after 90 days only. But like a bank is financing money to me, so he will be charging interest. So that is an expense to me. And amount available for advance, balance only, man. Amount available for advance or annual credit sales minus factoring commission minus factory reserve into collection period, rate of interest, man. So I will be getting the total. So one simple thing, if I am not able to recover the money from the debtor, my dear lovable students, I can give the management to a factor. Then I can save the administration cost, I can save the bad debt, I can save the interest. Sir, but sir, I have to incur the factoring commission. And since he is paying the money in well in advance, my dear lovable students, he will be charging some interest. So that interest I have to calculate, and it's an expense to me. And the same thing, my dear lovable students, you can find out the net benefit. If the net benefit is positive, go with the factor. If net benefit is negative, don't go with the factor. That's what the discussion is all about, my dear lovable students. These are the max to max, sir, things you'll be getting. Sir, now in the last minute of your preparation, you can prepare for estimation of working capital management, point number one. And number two is debtors management and the factor. Thus, from this three topic, if you see three questions, that itself is more than for examination. I am wishing you, my dear lovable students, all the very best for today's examination. Proceed today's examination like anything, my dear lovable students.